business, partnership, and diplomacy gets done.
We've been always there for the U.S. It's not something that we've been doing to buy an influence, but this is a duty on us as a partner.
It's going to take growth in Qatar. It's going to take growth in the United States, the two biggest suppliers in the world, to satisfy the enormous amount of energy growth that's coming.
The GC countries and the economies are bright spots or jewels in the global economy today because of the ability to plan long term.
Do you think there is a chance of Iran also being brought back into the fold?
That's probably a bit over-optimistic, but there's a chance that there could be a nuclear deal that doesn't have some of the shortcomings of the previous nuclear deal.
Unless we have data about the tariffs and the impact of tariffs in the prices, central banks cannot move forward.
These are unprecedented times for those of you who are new into the marketplace, and it's not normal that you have volumes surge to double or triple the levels that they are trading on average. But those are providing opportunities once the markets resettle.
We're revising very deeply how much we should have in fixed income as a conservative asset class. And we're thinking very deep also some of the traditional asset classes that we have, whether we need to increase or decrease.
Well, right now we think investment-grade bonds aren't really good risk. I think U.S. Treasuries, long-dated U.S. Treasuries are interesting.
You have to help your clients to diversify their risks. And with volatility, you can actually grab a really good rate or a really good exchange rate to help. And look at new supply chains.
Now people are driving around with stickers in their cars saying, I bought this before we knew Elon was crazy.
And there are also people who are buying it because Elon's crazy, or however they may view it. So, yes, we've lost some sales perhaps on the left, but we've gained them on the right.
And did it make you regret any of, or think twice about your political endeavors?
I did what needed to be done.
Please welcome to the stage Bloomberg's Jumana Bersechi.
Good morning, everybody. Sabah al-khair. Welcome back.
Good morning.
Of the 5th Qatar Economic Forum. Well, yesterday we were honored to open the forum with His Excellency, the Prime Minister and Minister of Foreign Affairs of the State of Qatar, along with other thought-provoking contributions from some of the world's most influential voices, ending the day, of course, with Elon Musk. Now, today's program continues that momentum with discussions on energy, security, capital investment, digital assets, the business of sports, and much, much more. But before we begin, just a few important announcements. We would like to express our sincere thanks to our partners and our sponsors, our official partners, the Qatar Ministry of Commerce and Industry, Qatar Media City, our culture sponsor, Qatar Museums, our innovation sponsor, Qatar Research Development and Innovation Council, our premier sponsors, Qatar Investment Authority, Qatar National Bank, our knowledge sponsor, McKinsey & Company, our participating sponsors, IDA, HSBC, Investment Promotion Agency, Qatar, Qatar Financial Center, Qatar Free Zones Authority, Qatar University, our airline sponsor, Qatar Airways, our connectivity sponsor, Ooredoo, and our tourism sponsor, Visit Qatar. Now, to stay connected, the Wi-Fi network is QEF 2025, and we encourage you to download the Forum app to network and access the full agenda. We'd also love to hear from you throughout the day, so to ask questions to our speakers or to take part in live audience polls, scan the polling and Q&A QR codes behind me over there. And of course, you can continue the conversation online by using the hashtag Qatar Economic Forum. Okay, with that, let's get started. We begin with the Global Investor Outlook.
Please welcome to the stage His Excellency Sheikh Saud Salem Abdulaziz Al Sabah, Managing Director of the Kuwait Investment Authority, and Howard Marks, Co-Chairman of Oaktree Capital Management, for a conversation with Bloomberg's Stephanie Flanders.
Well, we are very grateful to have two enormously distinguished investors sitting in distinctive positions in the market, but I think just from talking earlier, share some of the same investing philosophy. We don't have very much time. I know there's great interest in how you approach investing in this environment, extreme short-term volatility, lots of noise, but also some structural long-term forces, not least the trends that are pushing up the cost of money relative to the last few decades. I want to talk about how you're approaching investing with your distinctive portfolios and approaches, but I know there's also a great appetite for getting to where that exactly is leading you on some of the practical opportunities you see, so I hope we're going to have time for both. But Sheikh Saud, you have quite recently become managing director of the oldest sovereign wealth fund, the KIA. Tell me something about how you think about portfolio construction in this environment.
Thank you very much, Stephanie, and it's great to be here today in Doha. And you said something about starting with noise. I would start off by saying, ignore the noise. If you're a long-term investor, ignore the noise. And how we look about global opportunities, we're going to talk about today about identifying opportunities based on mismanagement of risk. And as a long-term investor, you can't be lucky. In order to be successful, you just can't be lucky. Someone can be lucky in the short term, but over the long run, you can't afford to be lucky. And to successfully identify opportunities, you need 4 key things. You need to have a long-term strategy. You need to put a process around it. You need to surround yourself with the talent to pick the right opportunities. And you need to have the guts to make bold decisions when opportunities arise. And as a long-term investor going into portfolio construction, whether you're a sovereign wealth fund or a pension fund, you need to know where you're going, reverse engineer it, and you'll have a return of capital on average that you need to achieve. But that's where the main problem is, because investors sometimes tend to focus on chasing returns, but not looking at risk. So you have to assign a specific risk profile to your investment. And the perception is the more risk you take, the more likelihood of a greater return. But that can be deceiving. You can't avoid risk when investing. You need to understand it and know how to manage it. And risk can be deceiving because it's always an absolute number. It's always positive. But the more risk you take, the more the likelihood of a greater return. But the flip side is also true. The more risk you take, the more the likelihood of a lower return. And that's why you need to put a process around it. Because investing is rational, investors are not. And you need to eliminate emotions when investing, and we've seen that in the 6 months of this year. You've seen very volatile markets. You've seen animal spirits come at the beginning of the year, but they went into hibernation. And we've seen it change. And you'd think the world is upside down, but it probably isn't, and probably Howard has to say a few things about that.
Howard Marks.
Well, you know, this panel's kind of rigged because we agree so much. But, you know, the essence of investing is appropriately bearing risk for profit. If there's no uncertainty, you're not going to get paid very much. And as Sheikh Saud says, you want to have the right mix for your risk tolerance, but you also want to be aware in a long-term sense of where risk is being mispriced and thus where you can get superior risk-adjusted returns without actually taking too much risk. And, you know, the last 15 years have been a very rosy period. Basically, I would say in the last 15 years, the person who took the most risk made the most money. But by definition, that can't be true all the time, or it wouldn't be risk. And yet, when people go through a very hospitable period and risk-taking is rewarded, it builds up. It's self-reinforcing. Just at the time when you should be reducing it, most people are putting on more. So I think risk consciousness and knowing what's right for you and your institution, not merely return maximization.
I think a lot of people would listen to this and say, that's all very well, but it's assuming you can distinguish these things. So Sheikh Saud talked about ignore the noise, but you don't want to ignore the signal, and you somehow have to tell the difference between the noise and the signal. You've talked about risk and uncertainty, but certainly as economist, I consider there's quite a big difference between the two. Risk is calculable, uncertainty is not calculable. It's just a sheer amount of volatility. So for those of us who haven't got an infallible way of telling the difference between these things, how are you confident that you're ignoring noise and not important signals?
I think you need to focus on hard data and not soft data. So I think if you turn off the TV, and I don't mean turn off Bloomberg, but and look at the hard data coming out of the US, the hard data has been coming in very strongly. But investors have been reacting as if it's the end of the world. So what happened in the past month, I think, is quite significant. You went from a bear market to a bull market in 4 weeks. And that's not normal. And that type of behavior meant people were, because fear of missing out is real. That's the emotional part. So people have been buying into a rising market, then selling when things went south. And that means you bought high and you sold low, and you won't be in business investing, buying high and selling low. So, but in terms of signals, I would say it depends on the price that you're compensated on the uncertainty that's there. I think at the beginning of the year, we know there was a new president coming in. We knew about his policy about tariffs, so we knew about a known unknown, so we knew about tariffs. We didn't know what was the impact, so we knew about a known unknown, but we decided to do nothing about it. And I think that's when complacency came in, and some investors paid the price for it.
Howard, how do you distinguish these? I mean, when you say, you particularly emphasize the importance of understanding risk. But are there times when you say, okay, this isn't actually calculable, I don't know what the risk of this investment is?
Well, first of all, we never know the future. And that's where the risk comes in. There was a professor at the London Business School named Elroy Dimson who said, risk means more things can happen than will happen. And it is from the multiplicity of possibilities that the risk comes in. We have to acknowledge that. And, one of my heroes, John Kenneth Galbraith, said that there are two kinds of forecasters, the ones who don't know and the ones who don't know they don't know. And I think it's very important to know which school you're in. But it's our job to deal with uncertainty. We can't run from it. If risk avoidance ends up in return avoidance. We have to knowingly, intelligently take risk for profit. But the definition of the risk we should take is one that we're aware of, that we can analyze, that we can diversify, and that we're well paid to take. And that's basically what I've been doing all my life. And when I started work in 1969, the banks invested in what were called the Nifty 50, and they thought they were investing risklessly in the best companies in America because of the quality of the companies. And if you held those stocks for 5 years until 74, you lost about 95% of your money. And so these people were taking risks they were unaware of, and that's the worst thing you can do. Keynes said that a speculator is someone who takes risks he's aware of, and an investor is someone who takes risks he's not aware of. We want to do it knowingly, not run from it, but and try to emphasize in the long run risks that are tolerable in quantum for us, and hopefully, as Sheikh Saud says, underpriced.
And something similar happened, I guess, for many people who were holding the developed country sovereign bonds, thinking they were risk-free, going into 22, 23. Sheikh Saud, okay, this is all very nice, but people will be interested in how it applies to practical decisions you have to make. And one of them came up as we were talking just before we came on the stage. A lot of people are talking about sell America, or at least diversify a little away from America. if you're thinking about whether that's correct, you know, how are you approaching that? How do you think about America as an investment destination right now?
I would say it very bluntly: underweight America at your own risk, because people tend to talk about going underweight the U.S. and the question is against what, relative to what? They're mainly looking at equity markets, but they're not taking into fact the U.S. has the largest fixed income market, the U.S. has the largest private equity market, the real estate market, infrastructure and credit. Where is all those capital? Where is the capital going? And I think the U.S. has the breadth and depth to sustain its exceptionalism, and it has the rule of law as well. That still applies. So I would reiterate: underweight the U.S. at your own risk.
So does that mean that Kuwait will be joining the list, making commitments to invest in the U.S.?
That's a trick question, but
no, it's a very straightforward question.
It's a very straightforward question, and it goes back to your process and strategic asset allocation. If you developed a forward-looking strategy and put a process around it, you don't need to be reactionary. If you are already there, you don't need to be joining. That's how I would phrase it.
But just because I'm afraid there has been some talk about this, I mean, can we expect to hear an announcement that Kuwait will be joining the countries in this region who are committing to the US, big numbers?
I mean, the US is the largest, I would say, capital markets of the world. So obviously you'd have to be there. And if you want to grow, you have to grow with the US. So naturally speaking, as those capital markets develop, you'd be allocating towards them as well. And we've been allocating to the US for a very long period of time. And I don't think that's going to change.
Okay. Howard Marks, how do you think about, you'll probably say it's the wrong way to think about it, but how are you thinking about the US as an investment?
Well, look, I mean, the words US exceptionalism are on everybody's lips these days. And, you know, the US has really been preeminent in the world for the last 80 to 100 years, based on dynamic economy, respect for the free market system, respect for the rule of law, capital markets, spirit of innovation, many things. Those things haven't gone away. I think that the U.S. is still the destination of choice, and it is the majority of the world economy. It's hard to imagine that it shouldn't be the majority of anyone's investments. Exactly how you turn that into a number, that's where the judgment comes in, and it can't be the subject of an algorithm. And, you know, the world is going to have to decide whether what I said while we were warming up is that the U.S. is the best place in the world to invest. The question is it still as best as it was? And that's a judgment. Are we as dependable as we always have been? I mean, that every person has to answer that for themselves, and obviously that's a big topic today. But I can't imagine how a large, globally oriented fund could make a substantial reduction in the U.S. Everything has to go someplace. Where would it go? What's better?
So this is what, but most investors, and I would say this goes across, even by scale, from the smaller to the larger, would find themselves today disproportionately invested in the US relative to GDP, relative to many other things that you would measure. So if it is at the margin less attractive now than it has been in the last 20, 30 years, just in terms of sort of upside potential, is that something that could affect your overall allocation?
So this is how I would phrase it. So let's theoretically speaking, let's say you would say the equity markets are less attractive. You're going to take capital from somewhere and put it somewhere else. So you might take it from U.S. equity market, but put it into U.S. infrastructure. Mm-hmm. You might take it and put it in private equity, private credit. So it's still staying in the U.S. and it might even grow. So the question is just asking yourself the question, where is it going to go to?
And public versus private? How do you think about that?
That's a very interesting question, and I'm going to give you opportunities and risks in both sides of the market. So in public markets, I would identify the main risk is index investing. And the reason I say this is if you go about maybe 10 years ago, the top 5 names in the index made up maybe around 14% of the weight. And because of what maybe Howard described in his memos and sea change, public markets and indexing benefited from beta and liquidity over time, and a lot of flows went to passive, and that generated momentum, and the top 5 names right now make up maybe 30% of the S&P 500. You think that's a big number, but that's not even where the risk is. The 30% are extremely correlated to one another. And it's like adding leverage onto it, so it's like a double whammy. And we've seen how that impacted when the news of DeepSeek came, how the market dropped. And that's a signal you'll pay attention to. And how do you play around it? I would go by saying, I think active management is back. And I think that's how you play around. It might sound counterintuitive, but you would reduce your risk by increasing your tracking error, because you would move away from you're able to move away from these names. If you look at portfolios of the past, of maybe let's say last year, I just need to know one thing to know if a manager has over or underperformed their benchmark. Did they hold 6% NVIDIA in their portfolio? And that's the only thing I need to know. And in public markets, if you want to compare between debt and equity, it depends on the price and where you want to be in the capital structure. So on average, and over average is a very, I would say, dangerous word to use, but equity markets return 8% over the long run. If you look at what happened in April, high yield, even if spreads were not at historic levels, the all-in yield was maybe around 8%. And you're basically getting equity-like returns, just being up the capital structure. But you have to be ready, and you have to make a decision when that opportunity comes up. So that's on public. On private, it's a whole different story. I believe private equity is very troubled. And I believe, especially in the large buyout, venture capital, and let's say the rise of continuation vehicles, that's a very worrying sign. And private equity is in trouble because they got away of doing mistakes for the past 5-10 years without paying the price for it. And I think their time is coming up. And that's for maybe three key reasons. One is very poor underwriting with no process around value creation, but relying on beta, leverage, and multiple expansion. And in private markets, I mean, we love the GPs that we work with, but when they do something right, they tell you about it and they brag about it. So I would ask LPs to ask their GPs to let them show them their underwriting process and at what multiples have they been buying in their various vintages. And if they refuse to show you, they've been doing something wrong. Because they brag about it if they're doing something right.
What's your exposure now? Is that something, so are you looking to reduce exposure to private equity or just not expand?
No, I would say private equity is a very broad set, and I'll explain later on where the opportunities lie in private markets. I think the risk mainly is in the large buyout and in VCs. And one is poor underwriting. The second part is underwriting with no exit optionality. So when they underwrite a specific deal, they look at one exit path, let's say an IPO. Now, what happens if that market is shut? The third part is size drift. We've been seeing private equity funds grow up in size in time with the same number of portfolio companies. You're seeing them coming up at 10, 15, $20 billion in size. If the base case of underwriting is 2 times your return, it means you have to be realizing $40 billion worth of assets. Question is, who's going to buy them? And the answer is, I don't know. You put them all together, and you have the perfect storm. And this is what we have right now. You have $3 trillion worth of portfolio companies that are yet to be realized. And the worst part of it is they're approaching the end of their fund life cycle. The clock is ticking.
Well, the clock keeps getting pushed forward in some cases.
With continuation vehicle, but there is a limitation. Now LPs are asking for their money back. The clock is ticking, and buyers on the other side are being paid to wait.
You know, I think the thing to bear in mind is that we went through 40 years of interest rate declines. And when interest rates decline, valuation parameters go up, the cost of capital goes down. So the ownership of assets using borrowed money has a tailwind. I've described it as the moving walkway at the airport. It carries you along and you think you're making great progress. But declining interest rates obviously can't go on forever. They can't be the norm forever. And in a stable interest rate environment, like I think we're looking at prospectively, the special returns will go to people who can find underpriced assets and add value. And that's where the reward will be. And that's how the private equity industry will have to distinguish itself in the years going forward, not just buying, levering, and benefited from appreciation.
And that's why you're seeing opportunities come up in secondaries and in special situations. Is to provide solutions for LPs and GPs to get out of the problem that they're into. So that's where you're asking, okay, where do you go in private equity? I would say secondaries, I would say, is in a golden window opportunity because of not because of events that are happening today, but because of mistakes that were done maybe 5, 10 years ago, and now they have to pay the price for it. And the price probably is going to be steep.
This is why I'm reminded of my conversations with my teenage daughter as she starts to discover fast fashion. And it's trying to teach her the difference between something being cheap and something being good value. But Howard, on this private-public difference, and I think a sort of related point of liquidity.
Yes.
You know, we talked about indexes. One of the things that has pushed indexes up is it's sometimes illusion of liquidity, certainly the overvaluation of liquidity.
Right.
Now people tend to say, okay, you have to, illiquidity is the price you pay for having a return. Do you think that's still true? Do you think that's where the future is?
Well, in a normal market in which people are appropriately averse to taking risks, and including the risk of illiquidity, there will be a premium for taking it. And so that's a reasonable way to make money, as long as you don't underestimate the need for liquidity. I mean, the worst thing you can do is tie up money that you can't get out, which you might need. And, you know, Mark Twain said, history does not repeat, but it does rhyme. And one of the themes that rhymes from cycle to cycle is that when things are going well, people underestimate risk and they overestimate their ability to live without liquidity. And when things go wrong, they say, yes, now I understand why they pay you extra to take on illiquidity. You know, what you have to do is you have to be introspective and you have to realistically appraise your ability to live without liquidity. But liquidity is a real thing, and it's not just a number on a page. There might actually someday be a need for money. Now, you probably don't face it because you have a growing corpus, and it's going to grow for future generations. But everybody has to be at the right place on that subject.
You mentioned, Sheikh Saud, that the DeepSeek was an important signal to follow. How are you thinking about AI and allocation to that part of the market, to technology?
I think that's a very good question. And I think you can't, I would say, buy AI itself. I think AI is a big theme. I think the question is how do you get exposure to it and at what price? So you can either get exposure in owning the companies that develop the technologies, or you can get exposure through the enablers that help AI grow. And I'm going to talk about just briefly the risk-return profile where you're getting it. And I think the best way to get exposure to AI right now, maybe even as sovereigns and large allocators of capitals, is investing in the enablers of AI. So investing in data centers, power. Power is going to be the main issue, connectivity. I think those are the main exposures. And going back to what we were saying is you want to compare between owning an asset and lending against it. I mean, even in infrastructure spending in AI, even if it's classified as equity, the main opportunity is actually in lending. And by lending, I would say, is basically you would go out to a hyperscaler, you'd say, I would build you your data center and lease it out to them contractually speaking. So it looks like equity, but basically you're getting paid on a fixed income instrument by leasing it out. You're getting paid 10, 12, 13% IRRs on a single A, double A rated hyperscaler. That's a great way how to play AI, in my opinion.
Howard, AI?
You know, what I say is I don't think that AI knows everything that's ever happened and how stock prices reacted to everything that happened. So they can emulate the path to success that worked in the past. That's a pretty good skill to have. I believe that AI can't sit down with 5 business plans and figure out which one's Amazon. I don't think they can sit down with 5 CEOs and figure out in advance which one is Steve Jobs. So there are limitations. But of course, most people can't do it either. So I think that just like indexation and passive investing has supplanted much of active management in the large cap stock world, I think that AI will supplant a lot of investing and a lot of investors, but hopefully not the best.
Okay, last question, and you've sort of raised it. Both of you have talked about the mistakes that people typically make, and good investment being about avoiding those mistakes. But I guess good investment is also about recognizing that you too will make those mistakes. So what have you got wrong in the last couple of years?
So I think what you said is absolutely right. And I think it's always about everyone would do something wrong. Sure. You can't avoid doing something wrong, but the important is when you do something wrong is to refine your process along the way. And in hindsight, everyone has 20/20 vision, but no one can predict the future. So you need to focus on your process. But I would say two key takeaways for a long-term investor is that it pays off to actively decide to be patient. And sometimes the best investment decisions you make are opportunities you don't pursue. I would put it that way.
But what have you got wrong?
What have we got wrong? See, we've been around for 72 years.
And you made no mistakes?
We always make mistakes, but we learn from them. And I think it goes about sometimes you need to keep refining your process, and sometimes you get carried away when things do get right, that you think you're getting them right, but you don't know if it's luck or skill. And I think as now, the easy time of making money is over. You need to keep refining your process the whole time. I think that's what we've been focusing on. I mean, I'm privileged to have a great team working with me, and we've been focusing on process a lot. And I think that's the key thing. People tend to forget about process when things are going right, and they tend to panic when things are going wrong. If you keep your process there and have a playbook and a game plan, you should be ready when the opportunity comes. And I think, to be honest, as the KIA, we've always been ready when things went wrong. I think we've been great beneficiaries of the financial crisis. Maybe we've learned from our mistakes on .com, but in the financial crisis, the KIA played a big role in bailing out the financial services industry. And this man as well has made a lot of money in the GFC. Okay. So I think there's a few things we have in common.
We've not had a concrete example. Well, maybe 25 years ago in tech is the last time you made a mistake, is by the sounds of that. But Howard, very briefly, we're getting shouted at to leave. But where have you, what have you got wrong?
Well, you know, look, we all have our biases. We can't escape them. The most important thing is to understand them and limit their effect. I am a conservative person, and I'm a skeptic with regard to new and not obviously meritorious developments. So that hasn't been a good thing in the last 15 years. That would have held you back in the last 15 years. So I've had to suppress that, and you know, I can't always do it perfectly.
Okay.
I still think those are good values, but sometimes they get in the way.
Sheikh Saud, Howard Marks, thank you very much.
Thank you.
Please welcome to the stage Katie Koch, President and CEO of the TCW Group, and Rajiv Misra, founder of One Investment Management, for a conversation with Bloomberg's Jumana Bersetchi.
Hello. Really looking forward to our panel discussion, riding the macro wave, what's coming next. I actually want to start with what happened on Friday, Katie.
Okay.
We had Moody's downgrade U.S. sovereign credit rating. There is no single credit agency that has a AAA rating for U.S. credits, and you are seeing a reaction in fixed income. TCW, of course, fixed income focus. 30-year yields are inching back towards 5%. How big of a deal is this, especially because there's so much scrutiny now about the trajectory of the U.S. fiscal situation?
Sure. So thank you for that, Jumana, and it's such a pleasure to be here. Always delighted to be back in Qatar. As was mentioned, I'm the CEO of TCW. We're a global asset management company. As also mentioned, we manage a lot of fixed income. So I feel like we have some good perspective to answer that question. And we've also had the privilege of managing assets on behalf of beneficiaries in this region for 40 years. So moving on to Treasury markets, I'll tick through very quickly what happened, kind of why it happened, impact to markets, and how we're positioned, and I'll do it very briefly. So what happened, obviously we got a downgrade. It's not new news. It's the third downgrade to U.S. It's the last one of the major rating agencies. The first one happened more than a decade ago. But that was announced, as you said, at the end of last week. Why did it happen? I think the most simple way to think about this is looking at the credit of any organization. If you want to maintain your credit rating, it's usually a good idea to have revenues that exceed your expenses and not to alienate your lenders. We did a lot of that in the U.S., and this is kind of the result of that happening. Just to give context to people, because rates have stayed elevated, the interest burden now in the U.S., we spend more on that than we do on the military or Medicare. So this is quite a burden. And then to end with, what are the implications? There hasn't been a massive shift in the short ends of the funding market. We think that the implications here are that volatility is likely to stay elevated, term premiums likely to stay elevated, and curves will steepen. And then ending with how we're positioned around that at TCW, this is what I would say. When we came into the year, we were a little bit overweight duration at the short end of the curve and our maximum underweight position in credit.
Yeah.
And why was that? It's not because we were geniuses or we foresaw what was going to happen with tariffs. It's actually because we said, even if all these things are true, even if we get animal spirits and we get deregulation and we get tax cuts, markets are already priced for perfection. And that led us to come into the year in both public as well as private markets underweight credit. And then when we got the dislocation, we had our busiest trading day in 50 years and added to our credit positions in both private as well as public markets. And I'll just end by saying, you asked, what happens from here. I do think that risk assets, whether it's equity markets or credit markets, are too complacent, and that the soft data will eventually catch up with hard data, and we should get more opportunities to take advantage of dislocation.
Okay, I'm going to put you on the spot. Would you buy 30-year U.S. yields at 5%?
No, we are underweight the long end of the curve, and we are overweight the short end because our view is that we will have eventually, and it's not a catastrophic, we just think there's going to be a business cycle, and when that happens, the Fed's going to have to cut rates, and they can move the short end of the curve better. So we're overweight slightly the twos and the fives, and underweight the longer end of the curve.
And just on the outlook, you expressed some concern about the trajectory of the U.S. economy. Where do you think the downside risks are going to come from?
I do think that, you've seen, when I say the soft data, just to be specific, we had the worst reading ever second worst reading ever in the history of the U.S. of consumer sentiment. The hard data hasn't yet caught up to that. The tariffs are not going to be as bad as we thought on Liberation Day, but they're still not going to be zero. And I think as we get more data that comes out, markets aren't priced for disappointment. They're now back to kind of record tights in credit. and close to record highs in equity markets. And we would just say that's incongruous with the likely data that's coming out. And I just want to go back to the fact that for what we do, this creates volatility and should create tremendous opportunity to step back into the market, because the most tested way to create wealth for people long term is to step up and be a liquidity provider when other people can't or won't. And we have a strong view. We did it already in the second week of April, and we just think the market's going to give us more opportunities to do that in private and public markets.
The snapback in credit has been pretty pronounced. Rajiv, let me turn to you. If you were an investor and you'd bought Magnificent Seven in April during the peak volatility, you'd be up 30%. If you bought NVIDIA since mid-April, you'd be up 40%. I guess maybe the takeaway here is, and you can respond as you see fit, but don't underestimate U.S. tech.
Well, thank you for having me first, and give a little context on One Investment Management. We don't invest in liquid assets. We do more private investing. And I did that for 10 years as CEO of the Vision Fund before that. So we don't take short-term views on where the markets are going. We were long NVIDIA when it was a $30 billion company in 2017, our biggest position in the Vision Fund. And now in One Investment Management, I believe, as Katie said, there will be volatility. The market is priced to not perfection. There is enough risk premium. We have positive real rates. Inflation is at 2% and 10-year treasuries are at 4.5%. So the U.S., if you go back last 10 years, had negative real rates. So you're getting paid for taking risk. But you have to look at kind of the macro environment and say, where are the dislocations? As I was listening to Howard Marks before me, been reading him for 20 years. How should you be positioned is important over the next 12 months. It'll be volatile. It'll be anything but boring, okay? Go in where there is structural deficit of capital. What's happening in the U.S., if you look at U.S., Europe, the large economies, the liquid markets, you have thousands of regional banks who have withdrawn capital because of rising rates, and they were hoping that rates will come down and bail them out in 2025. That's not happening. So their books are still underwater with 2% loans. So the regional banks are not players in the U.S., which is by any day the largest market to invest in. Hence, there are plenty of opportunities to fill that capital gap with providing capital to different asset classes, real estate, construction, of housing. There's a structural deficit of houses in the U.S. To corporates, middle market corporates, to growth companies. It doesn't have to be NVIDIA or Microsoft. And the last thing I can talk about is predicting markets as to where it's going to go. There's a lot of retail hype and froth in the market too, with a lot of people who made easy money in 2024 spending a disproportionate amount of time becoming investors and trading electronically. But my advice would be keep enough capital aside. There will be dislocations, and be patient a couple of times a year and take advantage of that. When there was a dislocation in April, we looked at what could we buy that might have mark-to-market volatility with price, but won't lose money even if a 2008 happens. And there were triple B CLOs, double B CLOs, other liquid structured assets that we knew might go down another 10 points, but won't lose money over the next 4 years. And they traded extremely cheap, and you could buy $1 billion of those.
Yeah. Let me ask you about artificial intelligence and whether you think investors are sufficiently discounting how disruptive artificial intelligence is going to be to our lives.
No, we're sleepwalking into the disruption. So,
we're sleepwalking into disruption.
Correct. Because, and the generative AI right now are the large ALM models, OpenAI and others, and that's just the foundation stone, but it is moving fast. If you look at last week's news, Microsoft laid off thousands of software programmers across the globe, India, US, in Seattle. And you would think, if you went back last 5 years, and I am a member of the board of the UPenn advisory board, of the 400 undergrads who came in to study engineering at Penn, 80, 100, 120 would do computer science. Nobody wanted to do mechanical engineering and so on. So, but that's not the issue. Every white-collar job which is process-driven, what generative AI is good at is it has become good at answering questions. It's not good at, you still need Katie to ask the right question.
By the way, it's what I say to my kids when they go to school every morning. Ask good questions.
Yeah.
Humans still have to do that. I agree with that.
But to give an answer, they have processed every book in the world, every data in the world. So they are 1 million times more information than a human being can ever hold. So they can answer the question. So it now takes weeks to process a mortgage application, an insurance claim, medical claims, even in asset management will get disrupted. When we do lending, and if you go to a large alternative asset managers today, there are hundreds of people monitoring loans, monitoring assets, risk managing, so on. The computer will do an amazing job and bring down costs dramatically, bring efficiency in. Asset management, and Katie, as Katie would tell you, is a scale business. But scale may not be that essential anymore if it's generative AI, because the cost of doing business will come down dramatically. So the punchline is there are tens of thousands of businesses, mid-cap, small businesses, others. And when we invest equity or lend to them, we look at their last 5 years of financials. What is the free cash flow, EBITDA, profits, how much debt can they bear, what should be the equity value? But that need not be the next 5 years, because they will get disrupted. Because if you're a company that's processing mortgage claims, that's processing medical claims, that's doing actuarial work, aircraft leasing, what have you, which are human, white-collar, intensive jobs, the computer will do it better.
Katie, the thesis of America Inc. outperforming the rest of the world got tested in the last couple of months. And you see it in the performance of some of those key financial assets. There has been a recovery of sorts, as we just spoke about. How are you thinking about investing in the U.S. versus the rest of the world right now?
So I think, just breaking this down, there's this topic currently about U.S. exceptionalism and whether it's been permanently damaged and whether that's going to alter the risk premia. And so I want to kind of just say, like, what my view on what U.S. exceptionalism means, and then I'll talk about how we invest around that. So I think there are kind of 5 factors that have made the U.S. a really exceptional place post-World War II. The first is that we had very strong alliances. The second is, very quickly, an act from 1950 called the National Science Foundation Act, which, making it short, was just connecting research dollars from universities into the private sector. That has given rise to a lot of the technologies that Rajiv just talked about. Third would be the exorbitant privilege of being the world's reserve currency. Fourth would be rule of law and constitution. And fifth would be demographics, that as a country, we in theory can tap into 7 billion people, whereas, you know, China, the world's second largest economy, has a smaller pool to come from. That's historically been true. I think we could argue we're taking all of those out for a little bit of a test drive right now. But ultimately, I think while some of those formidable advantages are bendable, they're probably not breakable. However, I think both things can be true. I think the U.S. can remain exceptional, and I think it's still possible that investors are going to look to allocate marginal dollars elsewhere. And I'm going to complete that thought. And if we get a second, I want to say something on AI. And what I mean by those marginal dollars is the following. Like, there's a lot of talk about whether we're losing or we're winning. I just want to posit to people that the United States of America has 5% of the world's population, 25% of its GDP, and over 70% of its market cap. So we came into 2025, one might argue, with actually a lot to lose. And I really dismiss the concept that people would allocate away from the U.S. In January. I just said, that's not possible. We are the world's reserve currency. We have all these formidable advantages. There's nowhere better to allocate capital. I actually still think that's true. And the middle market, which you talked about, is, if you add it together in the U.S., the third largest economy in the world. So, I mean, there are amazing opportunities. But what I'm hearing from investors all over the world is, yeah, America's great. And it may stay great. But maybe I don't need to put more than 70% of my capital into that equity market. The UK pension market currently has 12% of its assets in 7 companies that are American. So I just think a little bit of the disruption and chaos has made people look at the portfolios and say, maybe we would, benefit from some diversification. And I'll end by saying a place in this region that we actually are seeing a lot of interest is in emerging market debt as an example, which has actually outperformed, as has Europe, the U.S. in debt markets, surely, and in equity markets as well, in the case of Europe. But back to emerging market debt, half of that index is investment grade. So you have a lot of people, a lot of LPs looking at that and saying, do I want to be with the U.S. IG credit facing tariffs and slowing economy? Or might I be with an IG credit in emerging markets where I can get similar or higher spread? Look at this country, in Qatar. You have a good quality credit that's actually deleveraging. So I just think people are open to the benefits now of diversification.
Yeah.
And can I just say one thing on AI before? Do you mind if I wanted to make one comment on what you said? Because there was a chart up before about the Mag 7, and have so much more experience in technology investing than me. But one thing I wanted to say, when we look at the future of AI, and we've had a dedicated AI fund for 10 years, I completely agree with what you said. Currently, we have like 70% in the infrastructure, which, by the way, was money losing for the internet. So time will tell. Like, we think this is different. We should argue that. But we have 20% in the software and 10% in what I would call the adapters to it. And I think that's going to shift a lot. And we agree that the winners are going to be the companies that figure out how to adapt themselves. This is a very important point. It might be real estate. It could be industrials. It might be hospitals that could be the winners of that revolution.
Financial services. A lot of industries need to be disrupted. So agentic applications of AI over the next 5 years is where the fun will be.
Yeah.
The companies that apply generative AI.
I want to ask you about a sort of parallel theme, because data centers require a lot of power, a lot of energy. And what has happened in the last year or so, the last 6 months, is the hype around energy transition, around ESG, has fizzled out. But when I speak to people, especially in this part of the world, when they talk about investing in data centers, they tell me a lot of that is actually going to be powered by renewable energies, by potentially nuclear energy. Is that going to give the energy transition basket another push?
Absolutely. And the push for green was good. We will need a lot of energy for many reasons. Data centers, we have 8 billion people on this planet, and of which 3 billion are becoming affluent in India, Southeast Asia, China, and in Africa, whose per capita consumption of energy is going to go up as they become affluent. So the demand for energy is going to go up dramatically, not just because of data centers, but because of human demand for energy also. They're going to fly more, they're going to consume power more. And hydrocarbons will always be important, and there are cleaner forms of hydrocarbons, like natural gas. But to me, the cleanest energy source always, there is hydrogen, there are other technologies, it was always nuclear. And I have seen quite a few companies, without naming names, who are doing small-scale modular reactors, SMRs, which require 5 acres of land. One SMR produces 320 megawatts. So if we put 2 SMRs, they're underground, so even if there's an accident, there is no spillover. The time from start to finish takes 3 years to put a plant together. It doesn't take multiple years with a lot of resistance from the neighbors, etc. It can be in the middle of nowhere where there is a grid. And so 2 SMRs with 650 megawatts can fire data centers and so on. So I see by 2029, the first SMRs coming on steam and producing energy, and there'll be thousands of SMRs in the 2030s, which will fuel and kind of fill the gap for the energy shortage that is.
Interesting. Katie, I want to ask you about private credit. You touched on it briefly at the beginning, at the start, and there's so much interest and so much money going into that space. Is it becoming more difficult to find opportunities?
I do think it is. First of all, I really appreciate Rajiv's endorsement for the asset class. And if private credit's like...
That's what we do for a living.
Endorse asset classes?
Yeah. Well, and allocating, but also just, you know, you've been very prescient on and getting lots of the parts of the technology market right. So I appreciate your endorsement of the exciting U.S. middle market. And we do think that there are opportunities there. You asked if it's getting crowded. I do think there are parts of private credit that are getting crowded. There is some optimistic lending happening in the large cap sponsor space, with a lot of money probably chasing too few deals. And so my advice to everybody in the audience is to be looking for unique sources of origination. This is very important. Like, what is the origination edge? This is why we've done a JV with PNC Bank, which is the #4 middle market lender in the US. It's to get unique origination with less dollars chasing the deals. I would also say, in private credit, the covenant is the asset class. It is the thing that made it different from liquid QSIP credit. And a lot of the market has given that covenant away. So you really want to push your managers on what is the underwriting, do they have strong covenants, and if we do have a business cycle, which we think we're going to get, do those covenants and does that documentation give them the ability to get to the table to work out on your behalf? And do they actually have experience of working out on your behalf? Because our view is we are going to eventually get some business cycle, and 90+% of private credit managers started post-GFC. So they've invested in a very benign environment for credit, and we would argue that things are getting rockier. And let me just end by saying, picking up on something that Rajiv pointed out earlier, which is finding out where there are gaps in the market, where capital's scarce. We think one of the best opportunities right now, really for looking out the next 10 years, is in rescue finance in parts of the U.S. middle market. So even in the absence of a business cycle, you have companies with upside-down capital structures put in place by private equity post-COVID, and a third and rising of our market cannot even cover its fixed interest charges. So you can go into those companies, get a high current coupon, get PIK, get warrants to be an equity holder. This is where the returns are in the complex and highly structured part of this market.
That's a great place to leave it. Oh, Reggie, one more. Yeah, go on.
Let me finish on private. What is important, whether it's private credit or any private asset, is be solution-driven. Don't go into a situation which is competitive, where five lenders are bidding to lend them money. Then you have no competitive edge. Yeah. Be solution-driven, provide solutions to, and it doesn't have to be corporates. Private credit can be asset-based, aircraft financing, shipping finance, leasing, real estate construction for homes, lending to corporates. Give them a solution where they're not able to find a willing lender. If it's 5 lenders vying to lend to them, back off.
That's good business advice. Panelists, thank you so much.
Thank you.
Sure. Thank you.
Please welcome to the stage Marcelo Claure, co-chairman and partner of Bright Star Capital Partners and CEO and founder of the Claure Group. Jenny Lee, senior managing partner of Granite Asia. And Stephen T. Mnuchin, founder and managing partner of Liberty Strategic Capital and the former secretary of the U.S. Department of the Treasury, for a conversation with Bloomberg's Eric Schatzker.
Well, good morning, everybody. It's wonderful to see you all here at the Qatar Economic Forum. You can see who my panelists are. I don't think I need to introduce them for a second time. But I'll provide a little bit of context. This panel, as you've seen, is called Hunting for Growth. And I don't need to tell all of you that these are uncertain and to a large degree unpredictable times. The markets, it's fair to say, have been struggling to see beyond policy shifts and through the resulting fog of confusion. And that's why we asked Stephen and Jenny and Marcelo to join me here on stage to help paint a picture that makes sense for people who are willing to take risk in search of growth. Now, before I turn to my panelists, I do want to remind all of you that we'd be delighted to hear from you. A little bit of input in terms of questions from the audience would be most welcome, and they'll come to me and I'll do my best to weave them into the conversation that I'm about to have with these three people here. So don't forget. I think it would be helpful, as I said, to establish a little bit of context, so I want to do the whole elevator pitch thing. I'm going to ask each of our three panelists to tell us in one or two quick sentences who they are and what they specialize in as an investor. Stephen, would you like to begin?
Well, first of all, it's great to be back in Doha, and thank you for hosting us here for this session. At Liberty Strategic Capital, we're mostly focused on technology and financial investing, particularly banks and insurance companies, and in technology across everything from data centers to cyber.
Jenny.
Great. Hi, everyone. I'm Jenny. It's great to be here. You know, as we were coming on stage, I realized that if you want to be an investor, you should be wearing running shoes. Because part of being an investor is you got to just run faster than most people. You want to get ahead of the trend. So Granite Asia, we are a global investor, early venture and early growth. And so what we do is we look for the best entrepreneurs, help to grow them as they grow from 0 to 1 to IPOs and, you know, to public. That's what we do on a global basis.
Marcelo.
I'm Marcelo Claure. I have a few different businesses, but where my energy sits today is having the ability to buy companies, apply AI, turbocharge them, and generate a lot of returns for our family office and my investors.
Terrific. And I would just point out, in addition to what Jenny said, that yes, if you want to be an investor, you need to wear running shoes, and if you want to be a moderator,
precious.
What I'm most interested in, and I suspect what you're most interested again, is growth opportunities. I want to know from our panelists, what is the single best investment opportunity in the world right now, regardless of industry, regardless of region, that you see, why, and how you're making it available to your clients? Marcelo?
I would say that today, everybody talks about AI, right?
They do.
We have to learn how to divide AI.
Ad nauseum, I might add.
And I'll say that most of the money, about $350 billion a year, go what I call the factory of AI. And that is, people are investing in power, investing in data centers, investing in semiconductors, LLM and applications. And it's incredible. Think about it, $350 billion a year. What I'm focused on and what I do believe single-handedly will be the most value creation is in enterprises that have the ability to grab the technology and be able to implement it, what I like to say, apply AI. And you know, we have a really good use case. I'm very lucky to be the largest independent shareholder of T-Mobile in the US, and we made it publicly that through a digital and AI transformation, we're going to generate close to $10 billion of profit. So put things in perspective, it has taken us about 120 years to get $30 billion of profit, and it's going to take us 3 years to add another 10. And what you can do in use cases, in customer service, in sales and marketing, in software development, in the back office, in supply chain management, and so on, And the reason why I say it's the absolute best investment is because what we do is we buy good companies and we make them great. So even if we don't do such a good job, we will always have a great company. So I've moved from being a venture investor, a growth equity investor, to now I see the single-handedly as the most important investment will be in buying incumbents who have an edge and be able to apply AI and make them great.
A couple of follow-up questions. What's a good example of an incumbent? How could you take a company that we might, or an industry that we might know and understand, and turn it into something that's so much better than what it is today that you can create the kinds of returns that you're talking about?
I'll give you an example. A company in the U.S. called K-Health. Today, we're the primary care physician of the world's leading hospitals, Mayo Clinic, Mass General. And the way it works is our AI will ask you the right questions about your symptoms, be able to combine it with your electronic medical records, combine it with our clinical AI, and in less than 5 minutes, we have the ability to diagnose a patient, prescribe, and develop a cure. And what we do is we grab that information and we pass it on to the doctor, because the doctor, at this point in time, will have the final decision. So what does that do? It drastically reduces the cost to provide service by 90%, and it also provides a much better quality than when a doctor was doing it on his own. So the results are radical. I mean, think about it, 90% reduction while enhancing, that's the power of AI, while enhancing the quality of care that we do. If I go back to T-Mobile, you know, the quality of service at a telco that you're able to provide customer service, when you have something called proactive customer service, what does that mean? AI, on a just-in-time basis, is able to predict if there's going to be an issue with the customer and fix it before it happens. Very different than you calling a customer care and complaining about my bill or complaining about I drop a call and all that. So these are real use cases that we as investors are so lucky that somebody else is investing in the factory of AI.
The second follow-up, why is a telco, why is T-Mobile, a wireless services provider, the right platform from which to operate?
Well, I'm very lucky to be, like I said, the largest independent shareholder. And when you have a company that has 130 million customers, a huge proprietary data set, then you're able to innovate. And we have deep partnerships with OpenAI. We have deep partnership with NVIDIA. And we've done some pretty incredible things. I do believe that the T-Mobile AI transformation, it is basically the largest transformation of its kind. There's no other company in the world that can say, we are going to generate an excess of $10 billion through a digital and AI transformation.
You're right. It's a bold claim.
And again, it's public. Go to our investor relations, see it. I mean, the management team committed to that number. So what happens when we do that? So some magical things happen. You start trading at 11.6 times, while every other telco trades at 6 times. You start generating profit at an accelerated pace that others don't do. So T-Mobile, healthcare, we can go on. And I think for the next 5 years, what we're going to see finally is the technology is there. It's amazing, right? And the winners are going to be the ones that have the ability to apply AI to existing legacy businesses.
Jenny, same question to you. Single best investment opportunity you see in the world, regardless of industry or geography. Why? And again, how are you making it available to your clients?
Yeah, so Ari, I'm going to answer your question separately. I think we saw for early stage venture and growth venture. So it's very hard for us to pick one company.
And you have to spread your bets, right?
Yeah, exactly. So for us, it's not about spreading the bet. It's really about looking at the ecosystem. And so when you are solving for early stage and early growth, what's very important for us, I think the key criteria, and this criteria has changed, is number one, talent, and where the talent is. Having played globally and invested globally for the last 25 years, today for sure, I think Asia is the place to be. So if you look at Asia broadly and the level of STEM talent from China to India, here, Middle East to Southeast Asia, we're talking about 6 to 7 million of STEM talent being groomed here on an annual basis, right? So that's a lot of, and I know we're talking about AI replacing talent. At the end of the day, businesses are still built initially by humans. And so I think the level of talent is very important. So this talent is here, this talent is hungry. And I want to add that with the world order being restructured, there's also an inflow of new talent coming back home, right? Whether it's back to the Middle East, whether it's back to Southeast Asia, whether it's back to China or to India. I think that's happening as well. With hyperscalers cutting off headcount in the US, there's also a lot of skilled talent the likes of those who have experience from, and Microsoft to Apple actually coming back. So I think number one, talent. We're seeing enormous talent flow back to this region, which gets us excited. And this is across the board, number one. Number two, markets are being reconstructed, right? In the past, US, China, homogeneous market, huge market, growth markets, that's where a lot of the innovation is happening. But today, the markets, whether it's building bridges from the Middle East to Southeast Asia, China to the Middle East, those bridges are being reconstructed in a very cohesive, friendly manner as well. And so I think we are starting to see the appearance of huge emerging growth markets other than the huge markets that we know, and I think that's a very important part. The third, where's the capital? Now, while a lot of capital has been flowing back to the US, whether you're overweight US or trying to diversify, I think US is going to be benefiting from a lot of the capital flow. But it's also true that countries are realizing that we have to keep the talents here, the ideas are here, the capital needs to be in line here as well. And therefore, the developmental effort by a lot of countries here in this part of the world is very important. So those are key criteria. Now, when you put that all together, I want to say that the trends, and I'll just highlight two trends, not one company. The first trend is that we see from a venture land that innovation is going back to foundation and fundamental technology. Now, why do I say this, right? We talk a lot about semiconductor. Now all of a sudden, all countries realize that we better have some semiconductor capabilities. And what's happening, right? So when I say back to fundamentals, the 28 nanometer process node for foundry is back in vogue. You don't have to be 3 nano if you have nothing. You start with 28 nano. And so if you just track where are the 28 nanometer foundries being built, today you have TSMC in Japan, you have India with the Tata Group coming out with their, taping out very soon with their 28 nano, Malaysia announcing, Singapore announcing strategies, and I'm sure here in the GCC as well announcing. And what that does is it allows basic fundamental technology that we thought we don't need. That's coming back in vogue. And I think that will crystallize the talent in fundamental technology. And so along that stretch, and this is actually clearly the foundation of AI, as we talked about, right? You have basic access to basic chipset. We may not need the 10 to 23 compute power, but basic technology that people are starting to learn. And on top of it is data, right? We have proprietary data here. Every single country has your own specific small language model. We don't need large language model. The LLMs are open source. You can access, compute at a very affordable cost today. So then it's about how do I then build the infra, build the technology, have the data, have the right rules, and then allow the ecosystem here. You have the talent, we have the talent. So I think that the one theme is around AI, we are actually going back to fundamental building block of the technology stack. So the entire technology stack, in our view, is being reconstructed. May not sound sexy, we're not going for the moon, but right now I think it's really going from 0 to 1 to 2. And in that AI construct, one particular area that we as a firm is very focused on is the whole concept of agentic AI plus robotics. And I think that this is also one area that Asia as a whole has the right to win, right? First, we have manufacturing capability here that allows us, whether you're building humanoid robots or machine-looking robots, at a very good, scale, efficient, affordable ecosystem pricing as well. That's number one. Number two, many of the countries here don't have the luxury of being able to put people back into factories. And therefore, whether it's here in Qatar, right, 300,000 in terms of population, my home country, Singapore, 5 million, we don't have the human power to be able to compete to do everything. But agentic AI plus robotics allows us to build this automation capability that can allow us to 10x our labor capability in a way. And so being able to now, imbue our robotics with the right, generative AI or agentic type solution, I think it's actually one way for this region to actually leapfrog. And the second thing is this. The application scenario is here, right? If you just look at transportation, logistics, air, sea, and land connectivity, this is a diverse region, different countries, different ways of modes of transportation. And if you can combine this together, connecting the regions with the right, not just human, but robotics combination, I think this is where the next new amazing companies will be built.
Stephen, over to you with the same question. Single best, where, why, and how are you making it available?
Well, a lot of comments on AI, and I think there's no question AI is going to impact everything we do. And I agree, the opportunity to take great companies and use AI is going to transform. Also, the issue of jobs. What do we do with jobs? Because there's no question, you look at things that are customer service oriented, and the AI is so much more efficient. As we look at across all these different opportunities, what we really like is data centers in the U.S. And, the one thing that we know is that AI is just going to create this enormous demand for data and this even growing opportunity for cloud computing. So for us, owning data centers for 20, 30, 50 years, we're going to have a limitation on power in the U.S. There's no question over the next 20 years, the technology will change for chips. It'll become more competitive. NVIDIA may not be the only major provider. So I think you're going to have a big technology refresh over the next 20 years. But the one thing we know is you're going to need data centers, you're going to need power, you're going to need cooling to support all this growth in the cloud. So we look at them as long-term bonds.
Interesting. There's no question, everyone, that that some of the shifts that we've seen over the past 4 months in U.S. policy, and let's not forget it's been only 4 months since the inauguration, have changed conditions in markets around the world and changed conditions for industry and thus created new opportunities while perhaps, I won't say destroying, but weakening perhaps the opportunities that people may have seen previously. Jenny and Marcelo, you both have respective backgrounds in Asia. We've heard a fair bit about Asia from you, Jenny, already, but Marcelo, Latin America. Can you tell us how those shifts, from your point of view, have changed conditions in those respective markets? Why don't we start with you, Marcelo?
So another thing that I do is probably one of the largest investors into Latin America. That's where I'm from. I'm from Bolivia, so I'm passionate about what Latin America can do. And I think that all these new changes in the geopolitical landscape, Latin America should benefit enormously. Mexico sits right next to the United States. And a lot of the manufacturing companies that used to solely manufacture in China are moving at the fastest speed possible to serve the U.S. market from Mexico. What has happened? For the first time in over 50 years, Mexico becomes the largest trading partner to the United States. China is no longer that trading partner. Number two, the world is growing towards the global south. Most of the food that the world will consume, the additional food, is going to come from Brazil. Brazil becomes the feeder to the world. If we believe the world is going to electrify, which I do, most of the critical minerals come from Latin America. Lithium alone, 60% of the world's lithium sits within 3 countries. My home country, Bolivia, which is about 30% of the world's lithium, Argentina, and Chile. Same with copper, same with nickel, etc. So I look at Latin America's opportunities. Feeder to the world as it relates to food, number 1 provider of critical minerals in order for the world to electrify, and the largest trading partner, all supply chain move. The alternate supply chain to China is now Mexico. So now Latin America comes with its complications. So I think the potential, I don't think even if Latin American politicians try to screw this up, they're going to be capable because the forces are greater than them.
Jenny, quickly from you, the good and the bad as a result of these big shifts in U.S. policy that we've seen these past few months.
Yeah, I mean, the first 20 years with globalization, it was about finding that one leader, the ultimate, category leader that can take on the world, and that's where you get premium, right? You get, and large companies has economy of scale, and therefore they are able to then dominate the world. I think with the new world reorder, it means that there will be regional clusters of excellence. There will be regional clusters of great companies. And so it's okay to be number 2, because you could be number 2 in every single region and still command that premium. Because today we talk about AI, we talk about data, we talk about processes that's going to be very specific to industries, specific to countries, specific to regional challenges that needs to be built and addressed. And therefore, the good of it is that now it's not just going for that one company and overpaying for that company until the returns go to 0. It's actually about finding regional champions, which could also be huge category leaders for us as funds as well. And I think it's actually good for the world to have multiple pots of excellence that can be localized to its own needs.
Stephen, you're in the unique position on this stage and at this conference of having been the U.S. Treasury Secretary. I think it would help us all to understand from your point of view what are global markets misinterpreting or misunderstanding about the intentions and the approach of this second Trump administration.
Well, let me just say, I think there's a lot of similarities between President Trump's economic plan now and what we did in the first administration. And really the three components of that: tax cuts, regulatory relief, and trade. Obviously, there's a lot of activity on the tax bill, the one big beautiful bill going through Congress, which, you know, I think will pass quickly.
Do you?
I do. I think, you know, I think there's some issues that still need to be resolved, but I think that we're on track to see that happen early summer. The second part is regulatory, where we've just seen huge transformations. I mean, if you look at, you know, what's going on in the banking business and all of a sudden opening credit up and other opportunities, I think you're really seeing a transformation of regulation. Now, the big difference is trade. President Trump has always been focused on trade. This is something he's been focused on for 20 years, not just the last 2 terms. And he's determined to create a level playing field of trade. I was very involved in the situation with China. I think there's no question that our markets were open to them. Their markets were not open to us. And if we can open up the China markets to U.S. businesses, there's a huge opportunity. And tariffs play an important part of getting people to the table and negotiate. Now, I'd say the only difference is the president wants to use tariffs to create revenue, and I think he's been pretty clear on that. I've talked about the idea of taking a 10% tariff across the board, scoring that, using that as part of the reconciliation process. That's not going in, but I think the markets have kind of bounced back and kind of have assumed that the president's just deferring all these things and not making big changes. I think we're going to see big changes, and there clearly will be winners and losers along the way as a result of that.
Since you brought it up, I'll ask you a follow-up question on the tax bill. There are 2 groups that need to back down if this big, beautiful bill is going to get passed. On the one hand, it's the SALT camp. It's the congressmen from New York and New Jersey and California who want to see that cap raised. And on the other hand, it's the more conservative representatives who want to see greater spending cuts. For your prediction to hold, for this to pass in the early summer, who's going to back down?
I think it's going to be compromise on both sides. So, you know, you've seen in the press the discussions of the SALT cap going from 10,000 to 30,000. That's both expensive and a pretty meaningful change to people. My guess is it'll end somewhere around that. And, you know, in regards to the spending issues, you know, I'm very concerned about the budget deficit. I think that the budget deficit is a larger concern to me than the trade deficit. So I'm on the side of I hope we do get more spending cuts. Something that's very important. You've seen the Treasury market back up. I think less as a result of this rating change, which I would still rather buy U.S. government securities than any other AAA out there. I still think we're a AAA credit, no matter what the rating agencies say. But I do think you've seen a backup in rates because the Fed is on hold for the moment, and we have big budget deficits to finance.
Ladies and gentlemen, I wish we could continue this conversation, but of course we need to move on here at the Qatar Economic Forum. Please join me in thanking our panelists, Stephen Mnuchin, Jenny Lee, and of course Marcelo Claure.
Please welcome to the stage Omeed Malik, president of 1789 Capital. and Donald Trump Jr., Executive Vice President of Development Acquisitions of the Trump Organization and partner at 1789 Capital, for a conversation with Bloomberg's Jumana Brisecci.
Hi. Good morning again, everybody. So our panel is about investing in America. There's lots to talk about. But first I want to start with President Trump's visit to the Gulf last week. Your brother, also Eric Trump, he was in the region a couple of weeks ago. You're here today.
Yeah.
It's fair to say that the Trumps like the GCC region. What's the draw?
Listen, I think it's amazing to watch. I think if you said 15, 20 years ago that you'd have this level of investment in the Middle East, I think people would have thought you were crazy. I think if you look at the comparison here to what's perhaps going on in Western Europe, this is the place where there's rational investment. People are working hard. You're not dealing with a regulatory climate that's so oppressive that you wouldn't even think so. I think it's an incredible opportunity. And what I saw last week looked truly spectacular. It's an entire reset for the future of Middle East-U.S. relations, the business opportunities, and I think it was just incredible to see. It's truly spectacular.
Omeed, we're going to talk about the funds, but I know the primary purpose is obviously to invest in American companies, but you also were traveling with the president, and of course there were many business executives who were traveling around with the president as well. What were some of your impressions of the meetings and the energy that came out of last week?
Yeah, I had the opportunity to be in Riyadh and Doha while the president was here last week, and I mean, simply put, it was historic to see that reception from these countries, but also the kinds of deals that were made. We've never seen anything like it. And I think most importantly, just maybe from a geopolitical standpoint, it was a reset of relations between the region and the United States, which I think so many of us have been waiting for, particularly when you contrast it to the disastrous policies of George W. Bush in the region, or even the incoherence of the Obama administration. So to have someone come here and approach this from a realist foreign policy, which is what the people voted for, which is a more realist foreign policy and a policy of peace, I think was welcome not only here, but also at the United States, because it's what the voters wanted.
Don, the Trump Organization announced several deals as well in the last couple of weeks. Have you found that it's gotten easier to get business done because of perceived access to the White House?
No, I don't think it has anything to do with that. Again, we spoke about it backstage. I spoke, headlined the Dubai Cityscape Conference in 2007. We've had deals in the regions forever. It's something we've looked at, again, prior to most people finding it sort of acceptable to be over here. So I don't think that's changed. I think it's the fact that we've had these relationships for so long that so many of these things have been able to happen. People have talked about that, but the reality is my father was a real estate investor and a builder for 40 years. It's what we've done. And so as the region has developed, as more of these areas have really expanded, especially in the ultra-luxury sector, which is obviously the focus of the Trump Organization, those opportunities have abounded. But we've been talking and doing these things both prior to his presidency and during, for my brother and I, while he had nothing to do with those things.
Yeah, I mean, critics will say that the U.S. government probably shouldn't be doing deals with entities or government-aligned entities that are also doing business potentially with the Trump Organization. What do you think?
We're not, the Trump Organization isn't doing business with any government entities. They're doing it with private investors. I mean, many of the people in this room probably know them or have talked about them with that. And so, there is a very clear distinction between those things. In the first term, we actually said we're not going to do any foreign deals, even though that's what we did. Yeah. We had done it for years. We just said, hey, we're going to do this. And the reality is it didn't stop the media from constantly saying, you're profiteering anyway. We stopped entirely. Even the deals that were totally legit, it didn't stop the insanity. So this time around we said, hey, we're going to play by the rules, but we're not going to go so far as to stymie our business forever, lock ourselves in a proverbial padded room, because it almost doesn't matter. They're going to hit you no matter what. So we're just going to play the game.
Let me rephrase the question then. Are there any investments or ventures you would not get into because of conflict of interest?
Yeah, I mean, the Trump organization itself wouldn't be doing direct deals with government entities because that's not what they do and it's not what we have. But, so that would be it. We're just going to play by those actual rules that are laid out by the government. We're going to play by the rules, and it's as simple as that.
Yeah. And on the 1789 side, I think it's very clear. We only invest in the United States in private companies, and we take minority positions alongside the largest asset managers and most prestigious asset managers in the world. So it's quite simple. And then just if I may step back on the topic more broadly, I find it odd that this becomes a line of questioning, particularly when I look at the previous U.S. presidents we've had, both on the Democratic side, whether it's Bill Clinton or President Obama, who were basically broke when they came into office, have now become magically very rich. So I don't really like presidents that use the presidency as an apprenticeship and become rich later. I think that should be examined more than people who have actually done something in their life prior to coming into politics and then actually take a hit financially. Those are the types of people we should be supporting.
Yeah, I think all of us would agree that nobody in the vicinity or as a close family member should be benefiting from the president's office, position in office. Just on this point also, Omeed, both of you started up the executive branch in D.C. And again, there's been a lot of controversy around that due to the high membership fees. It's about $500,000 to get access to it. But then again, there's a perception that this is an opportunity for members to get closer to the axis of power.
Anyone who's a member there could get access anyway, so they don't need to go to a club to do that, so that's just a total misnomer. The other thing is that the actual memberships for regular memberships are a lot lower. That's been reported. And in addition, I think this is kind of the theme I want to point out here. What Don and I have been doing before we were invited to be on panels like this, I think only Newsmax was calling us during the Biden administration. Yeah. Not that anyone watches that here, but in any event, we've been doing this for 5 years. When we see a problem as if being censored or deplatformed, as was happening to conservatives in America throughout the Biden administration, we're capitalists. We create other opportunities. That's about as American as apple pie. The executive branch, that club, is another example of that. Frankly, everything in D.C. kind of stinks. So there were no good options to go and have social interactions with people with our ideological views. And so we wanted to create, again, a solution, which is what we do in every part of the economy through our fund. And we created another option for like-minded people as a refuge away from, respectfully, reporters and Democrats.
Yeah.
Well, I mean, perhaps we should talk more broadly even about the greater conflicts thing. I know for me, I get the Don Jr. is the next Hunter Biden. And I say it's such a false equivalence, right? I've been doing this for a long time. We were businessmen both before. We will be businessmen after my father's presidency. It's what we've done. I didn't become a businessman when my father took office. The difference being we have invested in companies for decades. I saw a problem that was out there. When no one would talk to us, when we were written off the face of the earth in 2020, I still saw the attacks. I started a publishing company, not because I think publishing is the most lucrative industry in the world, but because we had to make sure these voices are heard. I was the second verified user on Rumble. I helped them set up the pipe that enabled them to go public because the other social media platforms were canceling us. When Twitter threw my father off, we started Truth Social. So we created actual businesses as a solution to the problems that were being thrown at us. We got into cryptocurrency. That's another one I read about, a lot of conflict these days. We got into cryptocurrency because we were debanked. And so it's interesting. I mean, there's many people in this room that in the past I could have called at any time in my life, hey, I need a loan to build a building, because that's what we did. And I would have gotten a call back and a loan in about 5 minutes. All of a sudden, those people wouldn't take your calls. They wouldn't have your bank accounts. And so we did and invested in businesses as solutions. Yeah. The corollary to that is Hunter Biden, who magically became a businessman when his father took office. He was paid by shady foreign companies to peddle influence and influence American policy. And that's not what we're doing.
So let me just ask you a question before we move to 1789. But I do want to ask you, since you bring this up, free speech, do you still feel that you're censored? Because you're pretty outspoken. You say I think whatever you want.
I think Elon buying X was a major game changer, but we were censored across the board. By the way, I was on Fox News every day of every week for 5 years, and in the early 2020, after the election, I wasn't on for 2.5 years. So it wasn't even just the liberal-dominated media or social media platforms. We were just off. So again, we created our own solutions. We fought back. Elon buying X changed the game because it didn't become a conservative platform. Liberals just weren't comfortable with anyone being able to fight back. They were so used to anyone putting up a credible argument to them just being shadow banned, just being censored. We've seen that with our own eyes. So we created solutions to all of these things. They're not conflicts. They're a reaction to the market and to frankly, the landscape that was presented to us because, as I've said, we've always been business people who are coming up with those. We're innovators.
Omeed, let me ask you about 1789. I believe you've got about $1 billion assets under management. According to the conversations we've had in the back, I understand that the fund will only invest in industries that are aligned with MAGA philosophy. So what is in the portfolio right now?
Well, by MAGA, we mean Make America Grow Again, and that's kind of our thesis, and it comes within this paradigm that we've defined as entrepreneurship, innovation, and growth, which is our own acronym, which we find is a contrast to ESG. The notion that we observed is twofold. One, that the largest companies in the United States had become effectively monopolistic and were suppressing, in many cases, through a backdoor route, constitutional protections. He's talked a lot about the First Amendment. It's a reason why we've made investments in media. You saw the role that independent podcasts played in the election. The landscape is changing dramatically because people are hungry for that type of information. We invested in Tucker Carlson's new company. We invested in Substack, which is a free speech platform on the digital media side, trying to enhance the First Amendment in the United States through the private sector. And then, of course, we won't stop there. We believe the Second Amendment is also very important. Later this month, Don and I and our team will be taking a digital retailer called Grab a Gun public, where you can buy guns and ammunition online just like you can on Amazon because we have a Second Amendment right. But again, that's an entire area that's been starved of funding in the United States for ideological purposes. And by the way, it's not just about whether we think it's good or bad. I think it's destructive for shareholders. If you look at a study of public benefit corporations, which are companies that behave the way that ESG overlords would love them to behave, since they've gone public, they're down about 80%. So, you can say what you want, but if you're a capitalist, you shouldn't lose money. And by the way, if they want to lose money and do ESG, we're okay with that. Go ahead and do that. But we're going to provide the other half of the country, or probably 75% of the country, an alternative. And that's really the genesis of why we exist. We have now expanded that into, in our opinion, investing in the best disruptive technologies in the United States. And so our basic KPIs is we're looking for TAMs of over $10 billion, companies that are growing over 25%, and we're looking for a liquidity event in 2 to 4 years with 200 to 300% returns.
Isn't there an argument that what was the parallel economy is now becoming mainstream because of the change in thinking?
But someone had to actually do that. Right. It was very unpopular to do these things. We took another company public during the last 4 years called Public Square. An alternative marketplace to the places that were taking advantage of Americans. So many Americans, and it was sort of interesting, we did these things because half the country was being left by the wayside. Half the country was literally concerned about being debanked. They couldn't get insurance. They couldn't do so many things. And everyone pretended like it wasn't happening because they're in their spheres of New York and LA and Washington, D.C. They didn't realize what was going on with an entire base of probably about 150, 175 million Americans that legitimately had these concerns. They were flagged, by the FBI as being extremists or being terrorists because they bought MAGA apparel or a Bible. This stuff was actually going on in the United States. And so it was an entire segment, half the country, that no one would even cater to. So Omeed and I had been discussing this for years, since 2020, and we said someone has to cater to that. That was a big risk. That wasn't that easy because, again, of all the problems that went around that. But what's nice about us is because we took that risk, because we gave those people that platform that they so desperately needed and felt they weren't getting, I think we probably have the most credibility of anyone in the world to do this because we were the ones that had the guts and were willing to put our names, our money on the line to make sure that these people had a chance.
The 1789 is the year the Bill of Rights was introduced in the United States. So, it's very much part of the ethos.
So let me come back to that credibility point. Moody's just downgraded U.S. sovereign rating on Friday. The dollar is down 7% this year. lots of external investors are questioning whether some of the decisions made by the Trump administration, be it on trade, on putting America first, are actually going to be beneficial for the U.S. economy. Is MAGA working for the U.S. economy?
I think without question. I think if you look at even what happened in the last 10 days, trillions of dollars of investment. I think the problem that we have is these days, and with the media bias and hysteria, so many people expect you do something and it's instant gratification. You get whatever you want right away. The reality is that's not how the world works. These things take time to foment, to build up. You have to actually wait a little bit for these policies. You saw it when the S&P dropped in a week, and there's, oh my God, it's the Trump crash. Everyone's lost their entire 401k. What did it take? It took 10 days to get back to where it was, and now it's ahead. It's nonsense. It's hysteria driven by the media. No one who's ever done business, gets that instant return in 1 week, but they expect people to believe it. When the market goes down, it's the Trump crash. When it comes back up, Trump gets no credit for any of it, right? It's someone else. It's these other factors that did it. We've seen this story play out so many times, and I think it's why we're investing in independent media, because I think the mainstream media has frankly shot so much of its credibility by doing this. Everything's about clicks and hysteria, and if it's bad, Trump did it. If it's good, it's everyone else. It doesn't work that way. I think if you give these things time, if you let this investment take hold, this is game-changing for America, for the region, and for security in the world. And if you've been watching the world, I think everyone recognizes that a strong America is not just good for America, it's good for the world. Yeah. We've seen what happens for the last 4 years under weak leadership, and perhaps we needed that weakness for a while. We needed to hit rock bottom to understand just how fragile all of these things are, just how quickly our democracy, our freedom, the peace we've experienced under my father's first term can go away. We went from a time of prosperity to a time of poverty. We went from a time of peace to a time of war. And now, again, it's been, 8-9 weeks? Yeah. And we're already back at the table when the other administration wouldn't even have these things. So we can't be in a mindset, I see everyone nodding, so I think they agree. We can't be in a mindset that you do something, and the next day the stock market's supposed to go up 12,000 points, and everyone's happy. These things take time, and people have to acknowledge.
I'll just say one thing about Bidenomics.
No,
so you said MAGA, but Bidenomics gave us 20% inflation, okay, right? That's what you had there with Bidenomics, is 20% inflation, stagnant wages. That's what we inherited. So when you're talking about imposing a new order as far as the economy goes, we've already talked about resetting the international system, the failure of wars that broke out all over the world under Biden. So that's step one. As far as with the economy, you can't be myopic about it. Tariffs are only one aspect of the overall economic agenda. It's a necessary one and it's a tool, but you have to put that within the context of energy production in the United States that's going to finally be unleashed, closing the border so you don't have an illegal alien invasion which then depresses wages. You also have to have tax cuts and a deregulatory environment. When you put all of that together, that is the MAGA economy, and that is how we're going to grow in a way that we haven't in decades.
Yeah, so that's the overall thesis. And just to go back to what we were saying, we didn't really hit rock bottom. We had financial volatility, and of course markets have recovered.
Well, I'd say endless wars, millions of people dying for no reason, incompetence. 100,000 Americans die a year from fentanyl traffic over a border that was clearly opened for a demographic shift purposes. Okay, that's not a conspiracy theory anymore. We saw that 100,000 Americans. Just so we're clear, that's two Vietnams a year in America, and no one was even talking about it. There was a morality crisis. There was clearly with the inflation and everything else going on. The only people that benefited, frankly, for the last 4 years was big war, and that's a very powerful lobby in Washington D.C. There's no money in peace. And so I think someone said it the other day, if my father's one legacy is to be the president who created peace in the world, I think that would be his #1 legacy. And it's quite ironic that he's the only guy actually trying to achieve that when the soundbite for the last 9 years has been he's going to be the guy to start World War III.
Let me ask you about one of the other objectives, which is to bring manufacturing jobs back to the U.S. because there's a view out there that many of those jobs have been taken by Chinese workers. But at the same time, a lot of these jobs are low-skilled jobs, and the reason that it's been difficult to employ people in these spaces is because of low-cost needs and also because of the rise of automation. It's not going to be so easy to recreate all of those manufacturing jobs again, will it?
No, it's not. And I think this general thesis that, we're going to be making the little plastic figurine that goes in a McDonald's Happy Meal, that's going to be manufactured in America. That's not what we're trying to do. We understand we don't have the workforce. We don't have, it wouldn't make sense. But I do think we have to be investing in American semiconductors and making microchips and taking care of our pharmaceutical needs rather than being dependent. 93% of our pharmaceutical needs come from China. Well, we saw during the pandemic that the second they didn't like some of the sound bites, which now all happen to be very true, but we were told by China and the World Health Organization at the time that they were conspiracy theories, that it started in Wuhan, etc. They stopped sending over the ships with the protective equipment, the PPE. So we can't be reliant on those who have proven that they're clearly not our allies. They're adversaries at best. And so we have to make sure, and by the way, that's not just going to happen in America, but we can't be dependent on one nation. If this gets spread out to a whole lot of other countries who have these same mutually beneficial deals with the United States, that's good for the world, and we need that. That's good for everyone else to be able to have alternatives to China, because I don't think they're going to be a long-term good actor on the world stage, as evidenced by almost literally everything they do on a daily basis.
A country that does not control its supply chain has no national sovereignty. This is not about some, pie-in-the-sky idea or nostalgia. It's a national security issue. And President Trump was the first president to make that at the forefront. You simply cannot have a country that has 4 times your population and employs slave labor to produce everything for you. And by the way, we had no reciprocity in the relationship. So Secretary Mnuchin was starting to talk about in the previous panel, but it goes to every aspect of it. The notion that we have to have a local partner to do business there, yet they have complete unadulterated access to our markets. Even when they list companies on our exchanges, they don't have shares, they have ADRs, which means that our shareholders actually have no legal recourse against them. We can't list any companies over there. I mean, it goes on and on. So again, this is just common sense. And yet people want to say that, we're doing something that's bizarre. No, we're trying to bring back a United States that is strong and prosperous. And again, 1789 is investing in the reindustrialization of the United States in order to help foster that on the private side.
I mean, what do you make of the decision out of the Trump administration in the run-up to the trip to the Gulf last week to loosen those restrictions around chip technology? Because some critics within the U.S., the more hawkish voices within the administration, are saying that this could pose a national security threat because it's unclear whether that chip technology will eventually be passed on to China. What's your assessment?
Well, so exactly what those hawkish voices don't understand the irony of their position. So if you come to this region and you do not do business with these countries that are some of our best allies in the world, that are hungry to partner with the United States, you are therefore then pushing them into the hands of China. So it's a totally counterproductive position to have. We know that these are partners that want to go towards the West, the United States. Look, the future is in the Gulf, and you can see that the United States and President Trump recognize that this is a region that we want to double down on as far as a partnership goes, saying, no, we're not going to do business with you because we don't trust you. Well, that's a great way to enhance Huawei and the Chinese. So I think that's why it was such a smart move for us to partner with our allies here, and that's actually going to continue American dominance.
Don, do you think the U.S. fiscal situation is going to derail the willingness of people to invest in the U.S. because of this? There's concerns, serious concerns about the size of the deficit, the size of the debt overhang?
Well, I think the way to handle the deficit, and I think, again, a lot of that was added in the last few years. I mean, it's why you had the inflationary measures. But if you saw the inflation numbers that came out last week, hey, wow, they're back to normal. Because it's amazing what someone who's actually conducted business, being in charge of the world's largest economy, what that can do, right? You see what's happening right now. Again, these things do take time to happen, but I actually don't think that people are concerned about investing in the United States right now, especially under this administration. I do see those concerns the last time around because you had undue regulatory environment. You had individual companies being attacked because they weren't politically aligned. It was basically an extortion racket. You saw that. We dealt with that in New York all the time, even with the Trump organization, where we're getting sued for paying back loans on time with interest, where the alleged victim is testifying on the stand that no, we had a great relationship. We want to do more business with Trump, not less. So we're trying to create an egalitarian environment where everyone has a chance to succeed and create a regulatory framework that makes sense for these companies to come into the United States. That wasn't apparent for the last few years because no one knew what was there.
So the tax cut bill that's potentially going to be passed could add anything between $2.5 trillion to $5 trillion to U.S. debt over the next decade. Is it worth it?
Listen, it's going to work because of the growth that's coming in there. Again, you've seen in 10 days the amount of investment that's coming into the United States. That's going to trickle down through all of the people. And that's not just for the benefit of the rich, bringing back certain manufacturing and elite manufacturing so that we actually have highly trained people in those businesses. That's going to be incredibly important for the middle class. And that's what my father's done this for, right? I promise you. It was far easier being a real estate developer from New York City. I used to be invited to all the cool person parties. We didn't have these things. He got into this game because he was sick of seeing what happened to the people that he knew, loved, and learned from, because he wasn't your typical New York City billionaire. He was good as a developer because he spent time on the ground with real people, the construction workers. He listens to their opinions. He heard what was happening. He knew it, and he heard it for years, and he got sick of it. He's been talking about it very consistently since the mid-'80s when he was on Oprah talking about it. At that point in time, it was Japan who was taking advantages of us on trade. So he's been doing it for those people, and I think those people are going to see the incredible benefit all of this. What was happening right now was, in the past 4 years, was not working.
Yeah.
It was a problem.
Final question for you. MAGA ideology is dominating the Republican Party now.
Yeah.
After President Trump steps down, would you consider picking up the reins? Would you run for office?
Here we go. Well, oh boy. Well, it's an honor to be asked and an honor to see that some people are okay with it.
Those are just our friends in the front
that's
row,
probably
by the
just
way,
a couple people we know. Those are the tickets we got.
That's it. Right.
You never know. Right now, this has been my focus. I think it's not just about government. It's also about, the business sector doing that. I think when we saw, again, the woke ideology that has taken over corporate America for the last, decade or so, being on the forefront of combating that insanity, I think is fundamentally important. I think those two things have to go hand in hand. So the answer is, I don't know, maybe one day, that calling is there. I'll always be very active in terms of being a vocal proponent of these things. I think my father has truly changed, the Republican Party. I think it's the America First Party now, the MAGA Party, however you want to look at it. But I think more importantly, again, over the last 4 years, I don't mean to keep harping on that, these things we went through, the lawfare, the nonsense, the jailing of our constituents for, peaceful protests, it was insane. And what it did was it created an environment where you no longer have these milquetoast Republicans dominating the Republican field. Certain people, and a good handful of them, stepped up. They fought back. They made a name for themselves fighting the insanity. And now they have a following. So for the first time ever, the Republican Party actually has a bench of America First fighters who are willing to do this. Not another Mitt Romney, great, he'll come in, he'll be swayed. People who have the conviction to actually fight for what they believe. People who have the resolve to actually do what they tell their constituents when they're in a room with them and it's private. Right now, we've seen too many people, they'll sit there, they'll tell them everything they want to hear in a nice room, and then they go back to D.C., the Washington Post is going to do a hit piece on me. I'm going to change the entire ethos of everything I've told my people and capitulate. That is no longer. I've said it so many times. In 2020, all the Democrats had to do was be quiet. Okay, Trump would have won the election. I think everyone probably believes he actually won at this point. Anyway, I don't think anyone
that's
with
for
a
another
sentient
discussion.
brain actually believes that. That's another session. But all they had to do was let it go. Trump would have had a cabinet that wasn't always working for him. There were some people that were great and some people that weren't. Now, over the last 4 years, we have a team of tested warriors who believe in him. We know who those people are. They're fighting for him. They're aligned. And these next 4 years can be so much more productive. Had that not happened, again, you would have a sort of very average cabinet. They would have slowed him down. They would have slow-rolled it. You'd probably have, a Democrat president right now. I think this is the greatest opportunity. These next 3.5 years is the greatest opportunity to reset America, to reset relations around the world, to create prosperity and growth for everyone. and I'm all here for it. I'm super excited about it.
So I guess the answer to my question is maybe.
Maybe. You never know.
Donald Trump Jr., Omeed Malik, thank you so much.
Thank you.
One day, smart money is going to come into this business.
Not just financial assets, but there's a whole asset class now that's really emerged through the development of the Premier League. Today, I think that any rights owner, rights buyer has to put women's sport at the heart of what they do.
If you look at the sports ecosystem broadly, it's $3 trillion.
Families pass on fandom generation to generation. You don't see that in any other consumer product.
Please welcome to the stage Mark Atanasio, co-founder of Crescent Capital and chairman and principal owner of the Milwaukee Brewers. Ted Leonsis, founder, chairman, managing partner, and CEO of Monumental Sports and Entertainment. And Amanda Staveley, CEO of PCP Capital Partners, for a conversation with Bloomberg's Jason Kelly.
Okay, this is what we call in our business a hard pivot. We're going to go from talking about investing in America to investing in sports. So I'm really happy to have the three of you with me. We want to get you guys involved in this conversation. So I want to put up a poll about investing in sports. If we could show that, and you guys can weigh in on this, and I'm going to have the panelists weigh in as well. And it's all about where you would invest. If you could invest in any sport right now, what would it be? And just to clarify for the audience, when we say football, we are outside of America, so we're talking about the sort of football that Mark and Amanda are invested in, also known as soccer. So take a look at that. I want to start by asking each of you not just where you would invest, but let's talk about how much it costs to be in sport right now. It's really expensive. All of you have gotten in at lower levels, but Amanda, I want to start with you. Valuations, if you had to distill it down, how do they feel right now across the sport ecosystem?
Well, valuations are toppy at the moment. I mean, especially in football, in my opinion. I mean, we invested very well. We first went into Newcastle United. We were investing at under 2 times revenues. There is a big still dislocation between the European markets and the US market. So I think football has continued to be, you know, it's a prized asset, so there are fewer teams. So valuations have risen and continue to do so.
So, but feeling a little toppy, and if I'm translating that for the American audience, that means expensive.
Expensive, I would say. I would say, yeah.
Mark, do you agree with that?
Well, sure, especially because no one in sports really looks at cash flow or losses. They look at multiples of revenues.
Right.
So almost all of these teams actually lose money, even at the enormous valuations you see in the NBA. Cricket, you know, is on something we're looking at now, already being in baseball, football, and golf. Cricket clubs in the IPL in India are trading at 10 times, 12 times revenues.
Yeah.
In something that's emerging.
And so, Ted, what effect does that have on people coming in? You got in a long time ago. You know, you own a hockey team, a couple basketball teams, an esports team there in Washington, D.C. Are the prices high enough that people are sort of holding off, or are there always going to be buyers who are willing to pay up and up and up?
I don't think you can have a blanket statement, but I think we're terribly undervalued right now. It's the only category in media and technology that has kind of built-in annual growth. And if you're in a good market, I mean, we're in top 5 market, most important city in the world in Washington, D.C., but our media market goes Virginia, Maryland, 10 million households, very educated. It's an important business in that community. We're not just in the team business. We own real estate. I now have 1.6 million square feet. I can walk to the White House. I can walk to the Capitol. President of the United States decided to have the inaugural in our building. We were called the most important arena on the planet. And so I think the multiples by leagues are maybe a little frothy, but not on control changes.
Okay.
If you want to buy one of these teams, they are the jewel. No competition. Government allows you to be the only team in that region. And I think that the tree can still grow to heaven.
And so, Amanda, how does all of this inform what you look at next when you're thinking about sports investment? I mean, it's been public that you were part of the Newcastle ownership. You're potentially looking at another football club. How do you go about assessing it, and what are some of the metrics you look at to determine what is a good deal here?
Well, as Ted said, great clubs, story clubs will always attract a lot of, interest and investors. So there's a scarcity value. But what we look at is opportunity to grow that market. Most especially with the clubs that we're looking at, one of the difficulties is the new regulatory environment, and the cash flow is key. So in the UK, you have much more stringent financial controls, profit sustainability. So we're looking for an opportunity to invest where there's that arbitrage to get things, right. So I can appreciate that, there are some assets that are
right.
A lot of the clubs in the top of the Premier League, they change hands very rarely, and that's not always the same in the US. So I think we're looking for great opportunities in football at the moment.
Yeah. I want to hear what the audience had to say about this, but before we get to that, Mark, I mean, on that point that Amanda just made, part of your thesis in going into Norwich City in English football was that sort of, here we have it.
And the answer is?
The answer is, okay. Oh, so this is soccer dominates global revenue from, okay, we're going to talk about women's sports in a second. And here we go. All right, which sport you invest? Okay, so they're with you, Amanda. Football. I mean, not shocking, but football, you did it. So tell us
sure.
Why.
Well, it started because we felt with 20 years of experience in Milwaukee, along with operating management and 40-plus data scientists and analytics people, we could maybe bring some of that expertise to a sport where it's really been more about star power with players and coaches. Mm-hmm. We looked a lot at the impact you have in the community, which Ted and Amanda were talking about. Norwich City is at the east of England. It's a few 100,000 people, more churches than weekends, and yet when they put out a mental health video which is, I encourage everyone to watch, 2 minutes, globally within 2-3 weeks, 60 million views, 60 million. So the impact you can have globally in football exceeds the other sports, and that's really what attracted us.
So I want to talk about, some of the folks who are investing here, and all of you have had some experience with this, either in your non-sporting life or in your sporting life, which is institutional capital coming into sports. Ted, we're notably here in Qatar, which is a partner of yours, and that was a historic deal when the QIA, I believe, came in to Monumental as a minority investor. I want to start with you. What has been the effect, in your opinion, of having institutional capital come more aggressively into team ownership?
Well, when private equity started to come into the market, it frightened me because I have a private equity fund, and while I'm a large limited partner myself in the fund, you're investing other people's money, and you want some kind of exit.
Right.
And these are not the kinds of assets that are transactional. These are, the Capitals, it's our 50th anniversary. The NHL is over 100 years old. Our building, we're transforming it right now, it's 30 years old. They have longevity. Their connectivity in the market and in the community really is important. And so when I set out to find a partner, I fell in love with the people here, mostly because their view of the world was very synergistic with me and my family and my partners, which is Washington, D.C. is a very, very safe harbor to make investments in. The real estate market is going to be very, very strong, and we should continue to look at this as a long-term play. You can't look at it in 5-year horizons. I've owned the teams now for 25 years, and I paid $85 million for the Washington Capitals. Maybe they're worth $2.5 billion now. I paid $350 million for the Wizards, maybe $4.5 billion now. But that doesn't matter because they're not for sale.
Right.
What we want to do is to build long-term, and our business model looks like a SaaS business. I grew up in the tech industry. We're the first internet company to go public in America Online, and subscriptions and revenues that can be rejuvenated year over year. About 80% of our revenue is contracted. Our variable ticket sales, season tickets, they renew in a bad year at 80%. In a great year, 95, 96%. And so it's the safest kind of investment. We grow 5, 6, 7% per year. It's like a coupon. And as long as you don't do anything crazy and stupid, break the CBA, go into the tax. So if you're good partners, I thought sovereign wealth funds would be the right next generation partner for sports teams. We had to help to rewrite the charters of the leagues to allow pension funds and sovereign wealth funds to come in. And they've been our best partner. They're helpful when needed. They're very passive when you don't ask for help. And this would be a great investment for them. I take that responsibility very, very seriously. And sports, entertainment, technology, what I saw last night about the museum, it's dramatic. I mean, that's what we're building in Washington, D.C. I just built an art gallery right next to the arena. We're going to have a museum within the arena. These people get it. Education, universities, Georgetown plays in our building, NCAA plays in our building. As I said, the president held the inaugural in our building. These are the modern day conveners. And so we've built a platform where we control the IP, the teams, the platform of distribution, both through linear and digital. We own our network without any debt. We're the only regional sports network that has no debt. I heard a lot the last 2 days about debt. I'm a poor kid. I hate debt. And so these are good businesses still in the distribution side. And to be able to build a platform, multiple teams, all on one platform, I think is the right strategy.
Yeah. And so, Amanda, what is the effect in the near and midterm of this institutional capital coming in? You have direct experience with this. Does it impact valuations? Does it impact who grows faster? Like, play this out for us as you think about this new source of capital.
Well, I mean, I agree with what Ted said. I think sovereign wealth funds make great partners, and because they're much more used to long-dated assets and sport is, comfortable with partnerships that go on for 10, 15 years. I also think that institutional sovereign wealth fund capital has made the way we invest much more efficient in terms of we've been able to introduce regulatory rules which have attracted more private equity style capital because, you know, you have to be efficient. So I think that the more and more we get, the more traction you get sovereign wealth funds into this environment, you're going to grow the valuation pool, and good assets will always grow. I think what Ted has done and what Mark's also doing is important. We need to not be complacent. We need to make sure that we create the best type of, whether that's football or golf or whatever our speciality is. We need to make sure that when we look at what we're producing to the fans, we provide, you've got the right infrastructure. Infrastructure around sports venues is key. And Ted talks about having no debt in his content business. Debt is expensive. Cost of capital is going to, especially at this time, the cost of building a new stadium, a new arena is it's a lot of money. So if we
Ted knows all about that.
We just did a partnership with our city where we're redoing our arena and the real estate around it, and the city's putting in $515 million.
Yeah,
and it's been a great partner for us, and we've put in 200 already. We'll put in another 300. It's $1 billion new front door for downtown DC, and we'll be responsible for basically rejuvenating downtown.
And so Mark, Amanda mentioned golf, and golf was among the things people are investing in. You're part of Strategic Sports Group, a number of very successful team owners who have come in to sort of accelerate some of the things that are happening in golf. What happens next with golf? This is a sport that is very closely watched and invested in this region. What can we expect to see, and what's happening in the world of golf?
Well, interestingly, we talk about this story to these sports. Golf was probably founded in the 15th century, and King James in 1457 stopped the men from playing golf because they were playing golf and not doing archery, which was a military situation for the country. And so you've got something that's 600 plus years old, and that everybody plays everywhere in the world, whether you're 5 or frankly 85. We saw an opportunity, really John Henry at Fenway Sports Group, and the leads in that are he and Steve Cohn of the Mets and Arthur Blank of the Falcons, to the PGA. Actually, I think in a way people talk a lot about LIV. LIV was a really good catalyst for bringing golf into this proper today's generation and today's sensibility. So the PGA realized that it was somewhat sleepy and looked to bring in us as partners to really align interests with the players. Everything starts with the players in these sports, and then second with the communities. So our group of owners have helped manage the PGA, and whether that's, everything is up, by the way, starting with social media.
Right.
Above social media in baseball and golf probably was behind. Those sports were somewhat sleepy. In golf this year, we're up 60% in terms of social media metrics. We're up 10% in attendance in tournaments, and we sold $450 million of new sponsorships in the last 6 months. So, we're helping the professionalization of the sport, and I think that LIV occasioned that because everything was sort of just, complacency and was the order of the day. The future, I think we're hoping to align interests. You're dealing with 2 governments now. You're dealing with 2 groups of players, and you're dealing with fans and, by the way, players who want to see the best compete against the best. So we're hoping to be a catalyst to facilitate that.
And Amanda, we're getting a little short on time, so I want to make sure we touch on one thing that we saw a chart about earlier, which is women's sports. The whole ecosystem is growing. We see a lot about that in the United States. More recently, back in England, we saw the deal with Alexis Ohanian coming in the women's side at Chelsea. Where are we in that evolution, and what is the opportunity? How do you sort of suss out the growth opportunity? How would you characterize it in women's sports at this moment?
I think the Chelsea deal was extraordinary. I mean, incredible valuation and great on Chelsea because, you know, the first deal that happened, I think they did an internal deal, and now it really does underpin a valuation that will support a lot of clubs in the Premier League, especially in women's sport and women's football. You know, women's football, I always say, let's not be complacent. We have to attract more audiences, and we have to ensure that we get our fans to go to women's games, that it's supported not at the executive level, that it's not just done through corporate deals, that we actually get the broadcasters and we make sure that we drive everything towards the women's football game.
Right.
And I'd say women's sports is the growth stock right now. We own a WNBA team with a second most tenured ownership group in the WNBA, and what's happening there is indescribable. Sellouts, media deals, long-term commitments from sponsors, being able to sell suites, and opening up a whole new category of advertisers endemic to fashion and for women. And so I think that, you know, I'd like to make Washington, D.C. the women's sports capital of the world. Essentially, Title IX is what changed everything for the United States. And, you know, we have a great women's soccer team in D.C.
I was going to say, Michelle Kang very much agrees with you with that sentiment, I would imagine.
Yes, but she's a little bit off strategy because my belief is that a platform has to be regional and geographic.
She's going global.
Yeah, and
she's global.
So I don't want to acquire a soccer team in London, which always, it's like 20 teams within 50 miles. Like,
yes, there are a lot.
That wouldn't happen in the NBA and the NHL and the WNBA. But I do think that women's sports is just getting started, and they're being the multiple right now is the same as the NBA, 10 to 12 times. But the revenue growth is
But you have in basketball, you have the support, you have the media rights to support that. And I think there's a slight dislocation with the UK in that we don't have that yet. And I think there needs to be, you know, you guys have got it right.
I also think the way the leagues are structured, right? So the NBA, the NHL, we look at ourselves like we do in DC as a platform.
Yeah.
And so we've got NBA Africa, we've got NBA China, we obviously have been announcing work that we're going to do in NBA in Europe.
Right.
We'll have some expansion in North America. All of a sudden, we will look like a Google. We'll look like an Amazon, right? Where all of their growth started the first 10, 15 years in North America. But of the 9 billion people on the planet, there's 350 million in North America. You've got to go. So the pivot from analog to digital, North America to global, bringing in very savvy investors with a global mindset, I think augurs really, really well for these leagues.
So many more questions for you guys, and encourage you and the audience to find these guys outside if you can. So much going on in sports. Mark, Ted, Amanda, thank you so much for your time. Really appreciate it. Thank you all.
Please welcome to the stage Marcus Kreber, CEO of RWE AG, and Julian De Breda, President and CEO of Fluence Energy, for a conversation with Bloomberg's Francine Lacroix.
Hello, everyone, gentlemen. Thank you so much for being here. We have 20 minutes to redo the energy complex and try and figure out, first of all, how much energy we need and how much more because of some of these AI centers. Marcus, let's start with you. When you look at the global energy transition, what do you see as the current state of play for AI and data centers? And again, how much energy will it use? I mean, sometimes I look at the numbers and I have to read it 3 times because they're so massive.
So being in energy and especially in power, electricity, it's a great outlook. We know that there's more demand for our product through the electrification, but especially through the AI and data center boom. But on the other hand, you also know and realize that we are probably the facilitator, but currently also the bottleneck. I mean, how fast we actually see deployment of new data centers, and we need to overcome these hurdles.
Julian, how much more do we need to build from what we have now?
I mean, the view, there are 2 things that are, it's a huge change for our industry. Let's start with that. For the last 10 years in the developed world, investments in power have been essentially replacing technology. So there was no real hurry. You know, a coal plant was closed and a lignite plant was closed and then you were putting a new plant. Now our job is, accelerated investment, so jobs, taxes. So it opens a completely different world for us. We now live with an urgency that's tremendous. The idea is that, not only that, it's also a race. AI is a race. Whoever gets there first will win. We've seen that in most of the information technology business. It's a winner takes it all. So we need to help our economies win that race, and we need to move as fast as we can to be able to deliver that. That's the second one. And the third one, connected to this, is that I think, and this will come from clearly conflict, my own opinion, but that there's no way of meeting the needs of the power of the AI revolution without renewables. There's no way. We will need gas, we will need nuclear, we'll need, all this stuff. But there's no way. Renewables will play a fundamental role in that process. And we need to get ready for it.
And Marcus, will that be accelerated? I mean, again, to Julian's point, this has to be at speed. This needs, an enormous amount of capital being deployed. So what's the hardest part of what you're trying to achieve right now?
If you look at the individual pieces, it's not so problematic, but getting all ducks in a row, because it needs a lot of things to bring more power to the market. It all starts with permitting and planning. And that was actually across the globe, also in the US, but especially also in Europe. It was always slow because of the reason Julian explained. It was only replacing existing capacity, but now we need to build additionally more. Second is supply chain. And especially global supply chain in an environment where you have geopolitical tensions and discussion about tariffs make huge investments more complicated. You need to get your head around that. And then, of course, the infrastructure, so upgrades on the grid, and then additional generation technology, and I'm with Julian, it needs to be in all of the above strategy. We should do our research on fusion for maybe in the next generation. Nuclear remains to be seen, but very long timeline. We definitely need wind, solar, and battery solutions, and a good message, especially for Qatar. A lot of gas will be needed for much longer.
So if we focus on RV, I think your power generation has been declining since 2021, right? Now, because of AI, how much are you expecting to increase it by, and in what time frame?
So what I see, we operate in the US and in the European Union and the UK. What I see is the US is much faster and ahead of the curve. We expect power demand to grow by 3 to 5% per annum, depending on the different regions. Europe will pick up a bit later and slower, but from all the discussions we have to also make our infrastructure available to facilitate new data centers, it's going to come. Maybe not at the same pace, but it will come, and I expect breakthrough, as you have also seen with the first announcement yesterday in France. I expect the same for my home country, Germany, UK, more to come, but maybe 2 years later.
Are politicians having, first of all, the right conversations? Because, again, a year ago, everyone was saying, look, this is something that we need to fix about, but it was never #1 priority for government. So, first of all, has the language, has the immediacy of it actually changed?
I think the challenge we have today, I think that There are different things, but I will call you, I think the main change, if you ask me, what I think will make a big difference is at the regulatory level. Right. As we were for 10 years, just replacing technology, regulators got used to this idea that you could take time. A project could wait a year. At the end of the day, the electrons were not going to be, the electrons that come out of a coal plant are not any different than the electrons that come out of a gas plant. You know, they're not any different. But now that those electrons are feeding businesses, jobs, taxes, schools, you know, opportunities, well-being, speed is essential. We cannot wait 2 years for an interconnection. It needs to happen. So if you ask me, that's where we need to see the change. I think from the government side, generally there's a recognition that power will play an important role. I think from the markets, the financial markets are very supportive, so we haven't had an issue. That is where the trick needs to go. And the second point that I think we need to be, where we need to probably make a change, is that I think we need to be agnostics about what's the solution that best meets each of our needs. You know, so all of the above, to ensure that we actually can do things at the speed we need to do them. You know. Because there are a lot of solutions that sound very good, that will play a significant role, but that will take 4 years. 4 years from now, you won't be able to catch up with the Chinese AI. You won't be able. If you have to wait for that, it won't happen. You know?
But
I would like to add one thing what has also changed. I think politicians have not only realized that it's about speed, it's also about safety and security, because it is critical infrastructure, the power infrastructure as well as the data infrastructure. And we need to find the right balance between speed and protecting your data, but also protecting your critical infrastructure. And especially from recent events, we have seen the big blackout on the Iberian island, but also the messages from the US, what they found in certain devices out of Asia. That will play a very relevant role, how we set up this entire energy and data infrastructure.
I know Julian says you have to be agnostic, but actually how much does security and price come into play? Because maybe the two are at odds instead of working hand in hand.
I think you have two aspects of that question. One is your infrastructure safe? Yeah? And do you control it? It's a critical infrastructure, and if it breaks down, it has severe impacts on lives, on society. And the other, but that is only true for certain regions, definitely not the US, not the GCC region, but it's relevant for many parts of Europe, for Japan, Korea, where many of the energy currently needs to be imported. Yeah? And of course, how do you create a diversified energy import landscape, but also where can you actually reach more independence? And there, of course, nuclear and renewables are one way to get more independence.
I completely agree on the cybersecurity, and I will add, completely agree. That's the other point that we need to diversify the supply chain of our industry. We cannot have a supply chain just dependent on one country. Not because, any country is good or bad, but, just bad policy. So I think it's very, very important that we work on bringing that supply chain to, diversified. We clearly want competition, we want lower prices, we all want all of that, but we cannot be dependent on one country only. It doesn't work.
I was going to ask you actually about supply chains, given all of the turmoil and tariffs and trade wars. Like if you look at the energy complex, for example, how many battery cells comes from China, and how much will that change because of Trump policy?
Today, it's interesting, batteries, because the patents for batteries, or all the basic research for batteries, were done in the US and Japan. None of them came out of China. In the 1950s, and then over time, up to today, the LFP batteries, which are the most common batteries, were developed in MIT. Yeah. But right now, what happens, all the supply chain is in China. And that, I think, it's nothing against Chinese. I think the Chinese have brought this industry and can continue to provide lower prices, and they have done a great job. But we cannot depend on one country, and that I think, is a concern. No?
But apart from batteries, what other components?
Oh, the batteries are essentially Chinese. I think the other ones where we see a major concern. I think I would say batteries is the one where we have the highest concentration. Then I think it will be solar panels will be the second one. Wind is it's a lot more diversified because of the way it works. We are working, we're working very hard to bring our supply chain into the U.S. And we today have the ability to do a project fully 100% made in the U.S., very much dependent on the Inflation Reduction Act, so if it changes, that will probably be a little bit more difficult. We're doing it today, but we do believe that diversity of supply is fundamental for it to work.
Marcus, I wanted to ask you a little bit about the U.S. So data centers warn that actually, the president's attack on green energy could hurt U.S. in this AI race by creating power bottlenecks. Do you share these concerns?
I think the U.S. administration is definitely right on two things. One is energy is important, and energy is because energy will fuel the next big wave of data and the AI economy. Second is you need to have a consistent policy on infrastructure, supply chain, and the incentive to bring back supply chain to the regions, to the US. Europe should do actually the same, is also right. Where I disagree, and there I'm with Julian, I would be technology agnostic, because it needs to be an all-of-the-above strategy. We need to build everything which can be built as fast as possible because the demand is there. And we could actually build twice of what we currently build. We have a 5 gigawatt under construction in the US from the demand side, right. From the tech companies and data centers. But we cannot go faster because of supply chain and uncertainties around tariffs. So my advice would be clear that table, that we have more certainty. And I don't care so much what they incentivize, what they prefer, but I want to have investment clarity. And with the tariffs looming and can go up again, you go slower with investment, which is actually the opposite of what is needed.
That's right.
But the future, so staying in the U.S., the future of the Inflation Reduction Act, frankly, is still unclear. So what does that mean, for example, for your commitment in the U.S. to renewables?
The moment I have a stable investment environment and I know what I need to procure locally, what I can still import, and I know potential incentive schemes, I can I can calculate my projects, I can approach the off-takers and say, I can deliver you power at that price and we get a deal or not. The moment it's unstable and you don't know to put what into your business case, you pause, you go slower. Yeah?
So this pauses basically everything, right? It means that the race will be slower just because of the uncertainty.
I mean, the uncertainty creates a problem. Clearly, people don't want to commit not knowing what will happen in the short term. No, so I will say if there's any advice, quote unquote, or recommendation, let's settle the policy discussions quickly. Yeah. Uncertain policy is worse than bad policy. Uncertain policy is worse than bad policy. Having said that, I think the Inflation Reduction Act, I know that the current administration has a very critical view of that law, so, played a significant role in bringing in supply chains to the U.S. And I think that's something we should not get lost. You might criticize parts of it. There were things that were very political about it. But I'm not going to get into the details, but that portion we should not get. That idea of bringing the supply chains to the U.S. is very much a MAGA idea. I'll put it that way. That supply chain, and I think that hopefully when the Republicans are looking at this law, they realize that the incentives in the law that allow to bring the supply chain to the U.S. is very much aligned with the Trump administration policy.
I would like to build on that because for us as a developer and then building and operating the generation capacity, it's very important to de-risk your investments. And the moment you can buy domestic, it's a big de-risking exercise for your projects because you don't depend on tariff or geopolitical tensions. And it's interesting to see that over the last 4 years, the supply chain within the US have been strengthened. It's easier for us to buy batteries and solar panels domestic in the US than it is in Europe. In Europe, it's non-existing, and that was part of the policy which was helpful to get it done.
Could I have a snapshot, actually, of some of the conversations? And I know you're agnostic in terms of technologies, but what do you think the energy complex looks like in 5 years from now? So how much offshore, onshore, solar, wind, and actual, maybe fusion and others?
I can give you my opinion. We are a battery storage company, so I think my opinion, the markets are going to be, and I'm in Qatar, so gas and renewables.
LNG.
So that gas and renewables. I think that some of the other ideas that people fall in love with that look wonderful when you read them or look at the labs reports and stuff are not going to happen. There's nothing better than gas and renewables to feed.
And batteries.
And batteries are, you'll need both gas and renewables help with, need batteries. So that's, but I think those two elements are going to be, I think that's what's going to drive the future of power for the next year.
Basically, I agree. I mean, I'm not so much, I'm not interested in what the stack looks like, but what the additional investments look like. So what you add actually. And there I think it's clear that we need storage technology. So batteries, it's good for your business, right. Julian, needed in any case. We definitely need more gas. And then the question mark is, what is the rest? And there I would look at the timelines. I hope that we get a breakthrough in fusion technology, because that would solve the energy problems, not of our generation, but the next and the next one. But we cannot wait for that. But I mean, we should not give up on that. But short term, it is, and I fully agree, it's a combination of renewables, batteries and gas. Nuclear in whatever type will take much longer, and you can also not add significant capacity. Even if in the most optimistic cases for nuclear and SMRs in the US, it's by the mid-30s, it's still a rounding error.
How does the growth of AI actually in Germany and Europe delay or jeopardize the exit from coal due to the enormous amount of power we need?
I think that is clear. The slower we are with building new, cleaner technology, the higher the utilization of the old dirty stuff. And we see that everywhere. We have seen that in the US, we see that in Europe. So it's important to get the new technology in the ground.
But how do you see that? I mean, again, I think you want to phase out coal in Germany by 2030. And when do you know whether that gets delayed or advanced?
I don't care so much about the exact date, because you can only close a capacity when you have built new one. But the utilization needs to go down. And that is the important thing. Whether we close it then 30 or 35 as a country, we have as a company have a clear plan. We will get out by 2030. The country might need it longer.
I mean, I'm concentrating in how to serve the new demand, not the old one. So, hey, the coal, might take a little longer, but at the end of the day, I think the real solution, as I said, gas and renewables. No?
In the couple of minutes we have left, I wanted to ask you about money. We touched on it a little bit, but do you feel in general that there's enough capital being deployed in the right places, that there is enough money for this, because it has gone up the priority list for governments, but also for investors? Do people understand it, Julie?
We do. I mean, I think that our customers do very well. We haven't seen a major issue getting up to now. I mean, maybe things will get worse or will get more difficult over time, but the capital markets like electricity, like the business, they like the return. So I don't see a problem raising the...
Same for you?
Capital is not the problem the moment you have good investments. But if the investments are uncertain, the investors are all much more. We see that as a public. There's a big debate on our shareholder base. It's public that parts say the investments are currently so uncertain in the environment with tariffs and other. You better go slower. And I think we need to strike the right balance to work across the value chain, but also with regulators, politicians, to de-risk the project, because only when they are de-risked, we can get the capital at attractive returns. Yeah.
But I guess politicians understand that this is a race against other big superpowers. And if that's the case, do you think it sharpens and focuses the mind of politicians on what to do with regulation and uncertainty?
My view is it always sounds like that we discuss issues all the time, which is the right thing, because we actually everybody focuses on what needs to be done to go faster in the right direction. And I'm actually optimistic. I'm a strong believer in market forces, and I'm also a strong believer that in the end, maybe it takes some longer and we are all impatient, but that we work across. And many things have been achieved. When you look at infrastructure bills, also in the West, things can go faster than they were 5 years ago. If we move that direction, I'm optimistic.
What are you most optimistic about, Julian?
Hey, I think that changed from the fact that, we were an industry replacing technology to an industry that's now playing an essential role in the main race that we have today, the race for artificial intelligence. So I think that puts a pressure on us to do our jobs better, to think about technology, to think of new ideas. and it also puts some pressures on the people that regulate us to ensure that they give us the certainty and the guidance to ensure that we can make the big investments and create the technology and the projects fast. So excited about that. Hopefully 5 years from now we'll be here and we will be talking about the next chapter.
Yeah, what will we speak about in 5 years? What will we have fixed?
I think we basically probably discuss still the same problems. I think there will be a stronger focus on the security aspect. And if every region has sorted out a security aspect, maybe we start talking even a bit more about global collaboration again.
There you go. We'll speak before 5 years.
That's
Thank you for a good panel. Thank you both for joining us today.
Thank you so much. Thank you. Thank you.
That wraps this morning's sessions, everybody. Please join us for lunch just outside this room. We also invite you to join us for one of our breakout briefings starting shortly in the Fairmont Hotel. Lunch will be served there as well. One of the sessions is called What is Trumponomics for the Middle East? That will be a special podcast taping that is taking place in breakout room 1. And then the other panel is Global Real Estate Supply and Demand will be taking place in breakout room 2. We also invite you to explore the activations and exhibits taking place through the forum space, showcasing the creativity, heritage, and talent of Qatar and the region. Event staff are available outside to direct you. But please join us back here for 2 p.m., everybody, for our afternoon programming. We'll see you back then.